at a point right now where I think we can all agree the economy is slowing.
There is some evidence that some of that slowing in the macro data is starting to feed through to corporate earnings, and that creates a less constructive backdrop for stocks.
Policy rates today are restrictive. Why not have less restrictive policy?
To the market, what's going to matter most on all of these things is clarity. So long as there's clarity, the business environment will be able to handle it.
I got to say, we've never had this intensity of debates between bulls and bears.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It's just another quiet summer's week. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Sneak peek of futures. Equity futures look like this on the S&P 500, just about unchanged. Pulling back on the Nasdaq by 0.25%. The S&P, the first 2% plus drop for the S&P 500 in more than a year. And it's beginning to smell like a bit of a growth scare. Equities down, bonds rallying. Japanese yen just a little bit stronger. Commodities pulling back as well. One standout quote in the last 24 hours. Bill Dudley, former New York Fed president, joining us on this program at 8:15 Eastern Time. A must-watch conversation coming right up. Bramo, the quote, the Fed needs to cut rates now. Waiting until September unnecessarily increases the risk of a recession. He is in Mohamed Al-Erian's camp this morning.
He really set the tone at a time where there seems to be a shift in sentiment more broadly in markets. It seems like something has changed in the data, in the rhetoric from companies to really increase the urgency of cutting rates. Mohamed Al-Erian in a column for Bloomberg talking about how if the Fed does not cut rates this month or in September, they will be making a policy error akin to not hiking rates a couple of years ago when it was clear there was a real inflation problem.
I think on a morning like this morning, Lisa, it's really important to point out that both Mohamed and Bill were ahead of the curve on the other end of the conversation. There were two individuals coming out and saying this Federal Reserve needs to make a move now. They dragged their feet, they hiked far too late. And here are two individuals again out in front of the Federal Reserve saying, right now is the time to go. You need to make a move.
The real question, and this is something I want to get into with Bill Dudley and, frankly, all of our guests this morning, is what has changed so quickly? How fast is the pace of deterioration that people are looking at to really signal that the growth scare is now, not later, and that actually the Fed does not have the luxury of waiting in the same kind of way that they did 2 months ago?
In 2 hours and about 30 minutes, we'll get some jobless claims data. Other data as well, but jobless claims are interesting. Will they be higher or will they be lower? And the difference between being lower and higher tells you how much time this Federal Reserve actually has. It's the difference between having time and running out of it.
Right, and how much is the labor market potentially going to push them into maybe cutting sooner or fully next week, Powell putting September on the board, because we do know that they think inflation is coming down. What strikes me when you say Dudley and Mohamed Al-Erian were ahead of the curve, it was Mohamed Al-Erian who said that investors were not listening to earnings. Fed officials were not listening to the earnings calls, and what CEOs kept talking about price pressures. I'm waking up to earnings this morning that the Fed officials might want to take a look at, because it does look like it's in the opposite direction. People are not consuming. There is still price pressures on this, and it's turning people off.
Let's get into some of the earnings right now, and let's pick out two companies in the auto sector. Let's talk about Stellantis, and let's talk about Ford. Ford is down in the pre-market by 13.6%. Stellantis is pulling back by almost 7 percentage points. And I get it, Lisa. One's got a quality issue, the other's got a product issue, but at the same time, it's been a tough streak for this sector.
Especially because it comes at a time where the signal from dealers is that they're having to increase some of their incentives to move the cars off their lots. GM is looking more like an outlier. And that is the interesting aspect. They beat expectations. But Ford having an issue with quality, what does that mean? The fact that Stellantis is also having an issue with quality, although it is a bit more profit specific. My questions for these companies are, what is their bread and butter that they can go back to? Is this an electric vehicle problem? Is this something more broadly with consumer sentiment? Or is this something that has an echo to what we saw with Boeing in terms of personnel and the ability to get the required people to make sure the quality is good?
We've seen this in a few industries over the last few weeks. Difficulties in the airlines, tough business for the automakers. Throw in European luxury, Burberry, awful, LVMH, tough. Kering, the house of Gucci, check this out, we're down 7%. down 7% over in Europe. And this sell-off in the United States, with the Nasdaq down by more than 3 percentage points yesterday, it extends to Europe. It's not just about big tech. The CAC 40 over in Paris, France, down 1.8%. The FTSE MIB down by 2.5%. The story out of Gucci, AMH has been bad for a while. It's bad now too.
And it's 2/3 of Kering's profit, which is why if Gucci goes, the rest of Kering goes. What's more interesting is these numbers come after LVMH. And LVMH was doing better than Kering. Now it feels very bleak for the luxury makers as well as for the car makers. Besides GM, to Lisa's point, which feels like an outlier, it feels like it's a bleak morning for these two industries.
The problem is understanding whether this is weak or weakening. And you've been talking about this for a long time. Is this normalizing or is this rapidly deteriorating? To me, the idea of, yes, we saw the worst day for the Magnificent Seven going back to September 2022. Yes, we saw the worst day for the S&P going back to December 22. At the same time, the S&P 500 is up for 28 of the last 38 weeks, which is something that hasn't been exceeded since 1989. So that is where we are coming from.
Been quite a streak. We're still very close to all-time highs. Granted, it's a point worth taking. Look at equity futures right now on the S&P 500. We're down by 0.2%, pulling back just a little bit, a bit softer here. In the bond market, this is the rally we're talking about. Yields are lower by 6 basis points on a 10-year. At the front end of the curve, we're down 8. 435 on a 2-year. The difference between the two is getting narrower. Lisa, that curve is getting steeper.
Which raises this issue, is it the right kind of steepening? We talk about a bull steepener, which is it's being led by the idea that the Federal Reserve will cut rates possibly as soon as this month. Key question is, are markets pricing in too great of a rate cutting cycle? That is something that we heard about yesterday from Morgan Stanley. And the second question is, how disappointed will the market be, or potentially concerned, if the Fed say were to cut next week? This is highly unlikely, but these are some of the conversations that people are having, especially because a former Fed official saying that the Fed should cut next week has been sort of blamed for the sell-off that we got yesterday.
Look, it spooked people. And can you imagine if a sitting Fed official said exactly the same thing? I think it would spook people a heck of a lot more. There's a lot to talk about this morning. Here's the lineup through the next 60 minutes or so. We'll speak to Max Kettner of HSBC, following the S&P 500's worst day since 2022. Bloomberg's Josh Wingrove as President Biden calls for younger voices in office. And Julie Norman of the UCL ahead of the president's meeting with Benjamin Netanyahu. We begin with our top story, big tech's big reality check. The S&P 500 posting its worst day since 2022 as the AI rally faces its hardest test yet. Max Kettner of HSBC writes this: we believe in a broadening of the rally in the coming months, but not a full-blown rotation away from tech and AI stocks. Max joins us now for more. Max, let's start there and build it out just one more step. What's the difference between a rotation, a broadening, and a growth scare? And what are we looking at in the last 24 hours?
Yeah, good morning. I think a full-blown rotation really would be if we were to see something like August, September, October last year, where indeed we've seen that tail risk of further Fed rate hikes coming back into play. Right? Remember, we had the 10-year yield last year going from sort of 3.70, 3.80 to 5%. People were really talking about the real possibility about possibly the Fed having to hike again. That is no longer the tail risk. I think the tail risk now is, well, by the end of next year, maybe they won't be able to cut 6-7 times. Maybe they'll only be able to cut maybe 2 or 3 times. That's probably the new tail risk. If that is the tail risk, then actually there is a bit of a valuation tailwind also still for tech. It's not like last year where there's a constant headwind for valuations for tech, where there's a full-blown rotation then away from all these tech and AI and high-duration stocks and long-duration stocks towards the other stocks, towards the more economically sensitive ones. Now it's more about, well, it's tech, and tech earnings are actually still expected sequentially in the US to go down now in Q2. Earnings expectations for Q2 in tech are still pretty benign. Whereas, you know, when we look towards the end of the year, obviously we could see a bit of a broadening out. I do think, yes, there are the stories that you guys were talking about now at the beginning of the segment. But when we look at the broader earnings story, the beat rate is still close to 8%. Average surprise factors are still around 4.5%. So on aggregate, the earnings season so far has still been really, really solid. And that speaks for other sectors really to participate as well.
Max, at the moment, though, just to take a step back and take a global view, this feels like a global unwind of big consensus positions across the board: equities, bonds, foreign exchange. Think about what's happening with bonds. Massive rally at the front end of the curve. Look at what's happening with equities. Big sell-off in tech in the United States, in luxury, in Europe. Look at what's happening in foreign exchange. Consensus short, Japanese yen forever. All of a sudden, get long. Those big unwinds, Max, when they start to gain momentum, is that something you really want to step in front of?
Well, look, it's exactly what you're saying. I think what we're seeing right now is largely unwinding. When we look, for example, at our positioning indicators, CTAs have been very, very long equities, for example. So that really means it's probably more technically driven, it's more positioning driven, positioning unwinding, but it's absent of a fundamental change. Remember, we're talking about GDP nowcast still signaling around almost 3% real GDP growth. We're talking probably something around 5 to 6% nominal GDP growth for the second quarter. In fact, when we look at higher frequency indicators, look at the weekly activity index from the Dallas Fed, that in fact in the last 2 months has been picking up, right? We're starting to see things like same-store retail sales, things like freight volumes. We're starting to see that re-accelerate in the last 2 months. So on aggregate, the data are, I think we're getting a little bit too carried away with negative surprises, where in fact we are still seeing broadly stable data. And that's still pretty good. And when we go across the asset classes, look at the last couple of days, high yield credit spreads barely reacting, IG credit spreads barely reacting, emerging market debt spreads barely reacting. So it is largely, I think, a rotation within equities. It's a rotation away from long carry. But that, like you say, is largely sort of consensus unwinding. But it's in the absence of a fundamental driver. And therefore, that still keeps me pretty constructive then overall on risk assets.
Max, some people would say that the way up lacked a fundamental driver at a certain point. So other people would say that the way down might also lack a fundamental driver. And yet technicals are sort of imposing and can last for longer than many people would like. I'm wondering whether you have the conviction to go in and buy, say, tech stocks right now, because there has been a dip, albeit the first one in a long time, but there has been a dip that fully does represent a correction. Are you buying?
Yes, absolutely. I mean, we have been and we remain overweight in tech from a global equity strategy perspective, also within our tactical asset allocation, most overweight in US stock, absolutely. Because let's remember, I mean, we had one decent earnings sets also from Alphabet, Tesla, fine, not that great, right, on the Magnificent Seven. But I do think, going now into the next 2 weeks in terms of the broader tech earnings, there is potential for tech actually also on the earnings side, not only to deliver, but actually perhaps really to beat on those expectations. Because on a sequential basis, compared to Q1, consensus is in fact saying that earnings for the tech sector in the S&P should be going down by about $1 on the index level side. And that is, that's anything but exuberant. It's anything but spectacularly exuberant expectations. And that sets us up actually for a pretty good entry level now in tech as well as in some other sectors. I think it's really these kind of technically driven sell-offs in the absence of a fundamental driver. Where I would disagree actually with you is there is no fundamental upside from here. No, as long as nominal GDP growth is growing at sort of 4, 5, 6%, that's really should be filtering through into good earnings growth.
Absolutely, but that's a pretty strong caveat, as long as earnings growth is continuing at this level. What do you make of the growth scare that a lot of people are sussing out, including former New York Fed President Bill Dudley, including Mohamed El-Erian?
I'm not buying that at all, because again, when we look at the higher frequency indicators, look on aggregate, for example, credit card derived consumer spending is showing no signs of deceleration. When we look at, for example, global manufacturing, new orders over inventories, they're still picking up. When we look now at global central banks moving from hikes to cuts, remember how for 2 years we've been talking about the lagged impact of monetary tightening. If indeed we are now moving globally to rate cuts, we should be starting to talk about the tailwind that in the next couple of quarters will come from easier monetary policy. That should be helping growth. Look specifically in the US, we are starting to see things like freight volumes, things like same-store retail sales, in fact, strong and slightly picking up. We're also starting to see residential investment that has been picking up in the last 2-3 quarters, we've starting to see really also perhaps a bit of a tailwind even for housing data then, for housing surprises, as yields now have come down. So I am not on board with that growth scare, because when we look at economic surprise indices, we know that they've gone down in the last 4-5 months. So most likely, because by design they are a mean reverting time series, most likely the next move is going to be up rather than down.
Max, does the slump in French and German business confidence, though, this morning, that data, give you any pause?
Yeah, I do think, look, in parts of the Eurozone, when we look at Germany, I mean, some of that growth model is probably structurally somewhat challenged. The issue with that is, I think we shouldn't confuse the structural with the cyclical. Cyclically, that could still, there's still a possibility for a bit of a bounce relative to now extremely depressed expectations. Remember, October last year, what we had was consensus growth expectations for the US, for France, for Germany, for the UK, that were roughly at similar levels, roughly sort of 0.8, 0.9% GDP for this year. Now you've got core Eurozone countries close to 0% growth expectations for this year in terms of GDP. So the bar to beat, the bar for positive surprises out there is extremely low.
Not low enough for the luxury players, Max. Max Kettner of HSBC. It's good to catch up with you, sir. We're down 2% in Paris, France. In Italy, on the FTSE MIB, we're down by 2.6%. Over in Asia, cutting rates in China. Equities down there too. The Nikkei 225 in Japan, negative by more than 3 percentage points. 4 days of yen strength, unlocking some real equity weakness on the Japanese side of things. This sell-off goes global. It goes beyond big tech in America after the downdraft yesterday of more than 2% on the S&P. With an update on stories elsewhere this morning, let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Let's start with the tough set of earnings for the automakers. Stellantis shares falling 8.4% in the European trade this morning. It's currently trading at the lowest since last November. The car maker's earnings plunged by almost half, 48% in the first half of the year. The problem was most acute in the U.S., where it had high inventories, executive departures, and quality issues. Stellantis' CFO said it is likely to cut prices and is bringing back some old models like the Dodge Charger to try to win clients back. CEO Carlos Tavares will be joining the program in about an hour's time at 7:15 a.m. And shares of Ford also continuing to slump in the pre-market trade, down nearly 14%. It missed on profit for the second quarter, saying that quality issues led to a surge in warranty costs, specifically $800 million of warranty costs in the first quarter. CFO John Lawler said, quote, "We can't read this quarter as the year is coming off the track." It's not. And to that point, Ford did keep its earnings outlook for the year of $10 to $12 billion before interest and taxes. Elsewhere, Kamala Harris is about to receive some big-name political support. NBC News is reporting that Barack Obama plans to endorse Harris soon. NBC saying Obama and Harris have been in close touch since she announced her presidential candidacy on Sunday. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the president addressing the nation.
You know, there is a time and a place for long years of experience in public life. There's also a time and a place for new voices, fresh voices, yes, younger voices. And that time and place is now.
That conversation up next. Live from New York City this morning. Good morning.
Wednesday, the Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Live from New York City, welcome to the program. Good morning to you all. Equity futures pulling back just a touch on the S&P. Big sell-off yesterday, the biggest of the year so far. We're down about 0.25% on the S&P 500. The rally continues in the bond market. We'll spend lots of time on that this morning. Yields are lower by 6 basis points on a 10-year to 4.22. Under surveillance this morning, the president addressing the nation.
I believe my record as president, my leadership in the world, my vision for America's future, all merited a second term. But nothing can come in the way of saving our democracy. That includes personal ambition. You know, there is a time and a place for long years of experience in public life. There's also a time and a place for new voices, fresh voices, yes, younger voices. And that time and place is now.
It's the latest this morning. President Biden seeking to define his legacy in an 11-minute Oval Office address, casting his decision to step aside as an act of self-sacrifice. The address capping a frenzied month since Biden's disastrous debate performance reshaped this election. Bloomberg's Josh Wingrove joins us now for more. Josh, it was the beginning of a graceful exit from 50 years of public service.
Yeah, and one that, came a bit under duress, John, which I think sort of hung over the sentimentality of it. But to back up, this was sort of a capstone moment. He's going to be president for several months still, but this felt like a goodbye of sorts. And, hundreds of staff streamed into the residence of the White House to watch it, to greet Biden in the Rose Garden after. This really was this sort of rallying moment at a time after this sort of brutal month that he has had. Now, in the speech itself, he sort of spoke to the reality. He said he's doing this to unify his party. That is, of course, a nod to the sort of rising storm of calls for him to step aside, including from very prominent Democrats, frontline Democrats, swing state Democrats. He in some ways had no choice, and that's how we've had this just bonkers pace of stuff. And a week ago, we were sitting here saying, accurately, I think, that Biden at that point was dug in, was insisting on running, absolutely committed to seeking a second term at age 81. And then it just flipped, it seems, on a dime Saturday evening and Sunday morning and early afternoon, leading us to where we are. Just the pace of this is wild. But you heard in that first clip that almost defiant tone from the president saying, hey, my record, I think I deserve a second term, but it is what it is.
So, Josh, it's a week, it's 4 weeks exactly today since that disastrous debate that really kicked all of this off. And he did admit, to your point, the reason why he's stepping aside is it's become clear to me that I need to unite my party. How much fracture, though, is there right now between, say, Biden and people like Nancy Pelosi within his party?
Pretty much none, because he's taken the step that they wanted him to take. And so they've rallied both around him and praising his legacy to sort of calm any hurt feelings that might be coming from this. But Pelosi clearly was one of the figures that thought a change had to be made. And Biden throwing his weight behind Harris has seemed to have helped unify the party as well, because even if some of those big figures were thinking they might throw their hat in the ring, none have. And now it looks like a coronation of Kamala Harris as the nominee and sort of a unity and tailwind for the party that we just did not see when Biden was at the top of the ticket, including on fundraising, including on number of donors, and including on rally size. Donald Trump among those taking notice of the energy, comparing his rally size at length yesterday in his own speech. It's a big bugaboo for Trump. Trump also took the moment yesterday to take a little bit of a photo op on his plane flying home from a rally in North Carolina. Seems to almost be celebrating what this chain of events, of course, beginning with his debate, which Biden had this calamitous performance in, leading to last night capstoning sort of the, as I say, the 50-year career for Biden.
Yes, celebrating or trolling, depending on, I think, what angle you saw some of those photos.
Right.
Last night, he said he's going to keep working, this is Biden, to end the war in Gaza. We know he's going to meet with Benjamin Netanyahu later this afternoon. Do you think he's really going to add on more pressure for this ceasefire? What's the status of this potential deal?
Yeah, speaking of trolling, you could argue that Netanyahu has been doing some of that on his visit to America as well. I think right now that is one of the things that Biden says he's going to focus on. They've been saying for some time that they're really on the verge of getting some sort of agreement. The proof will be in the pudding. We really don't know how close they are. And so we'll be watching Biden closely on whether he's willing to signal that. And of course, whether he will publicly or privately think that his not running again leaves him more sort of elbow room to make concessions on that. Another one, Anne-Marie, yesterday, is he mentioned he did still want to do something on Supreme Court ethics reform. Big question mark on that, whether it's calling for something to happen or trying something by executive action. But nonetheless, all these sort of drumbeat and drip of Clarence Thomas stories really seem to be driving him to try to make some change there. The Supreme Court and potential appointments, of course, hangs over the next president as well.
Hey, Josh. Thank you, sir. Josh Wingrove there down in Washington, D.C. More on that story a little bit later in the programme. Coming up next, investors looking for more return on AI spending. We'll get the thoughts of KKR up next on the programme. What a week so far. Still not over. Equity futures on the S&P 500 look a little something like this, pulling back just a touch by about 0.25%. Down again on the Nasdaq by 0.5%. Monday, biggest one-day rally since June on the S&P. Wednesday, biggest one-day sell-off since 2022. Go figure. All over the place. The epicenter of the sell-off is tech, but I think we have to be clear, it's not isolated just to tech. At the moment, it's global. It's China. It's Japan. It's Europe as well. Switch up the board and get to the bond market. I want to talk about treasuries and the shape of the yield curve. Yesterday was an interesting one because the yield curve was getting pulled in two different directions. Two-year yields were lower. We were pushing higher at the long end. Either way you cut it up, however way you chop it up, the spread between the 2-year and the 10-year is getting narrower. This curve is disinverting. It's not steep yet. It's not steep at all. But the hope is it starts to normalise and you get this steeper curve all over again. What's it going to be driven by? Will it be driven by a rate-cutting cycle off the back of weaker economic data? Based on the comments from Bill Dudley, the former New York Fed president, on Bloomberg Opinion yesterday, that's what he's looking for.
So here's the question. Is this just weakening just enough to get the Fed into gear to actually start cutting rates? Or is this something more pernicious that will actually drag risk assets down with it because bad growth is bad for companies that want to invest? The signals from the market are confusing. I want to be very clear about that. And today is just another example. You see the Russell 2000 outperforming at a time of ongoing rallies in the bond market. That is unclear. Right now, it seems like Goldilocks for a lot of people. And this might be more sort of squeezing out of positions and technically driven. That is the question that we have to see. And that's why initial jobless claims today is so important.
Won't feel like Goldilocks if you've been short the Japanese yen. Into this one over the last 4 days. Consensus positions just aggressively unwound. From equities to bonds to foreign exchange. Check out the Japanese yen. 4 days of yen strength. Longest such streak going back to March of this year. We're down another 1 percentage point. 152.32, Lisa, on dollar yen. Going into the BOJ, where there is a real question mark hanging over that committee. Will they hike interest rates?
So there's a fundamental reason here, which is potentially the U.S. is having an increasing urgency for lower rates just at the same time that the Bank of Japan is more seriously considering higher rates. That said, you put it perfectly earlier this morning when you said we are seeing a big global unwind of consensus positions. This is one of them. Big tech is another of them. How much is this just basically profit taking at a time when valuations have gotten pretty elevated versus something that has legs? People are going to be debating that all week.
Is it something you want to step in front of? This is what we asked Max Kettner of HSBC about 30 minutes ago. This big momentum unwind. Pretty aggressive stuff, from equities to bonds to foreign exchange. Under surveillance this morning, our top story, President Biden framing his decision to end his re-election efforts as a bid to unify the nation. In an 11-minute Oval Office address, Biden also recognising the need for younger voices in office. I think we can all agree it was the beginning of what should be a graceful exit from 50 years of public service, but there was nothing graceful about some of the scenes taking place in the nation's capital yesterday afternoon, at a time where a very polarising figure, the Prime Minister of Israel, was addressing Congress. There were protests outside in the nation's capital where we saw them burning the American flag. I want to step back just a couple of weeks, maybe even a month or so. Steve Eisman of Neuberger Berman on this programme saying that Donald Trump will win the election, and let me tell you why. And he basically described the scenes we took place yesterday afternoon.
This is likely to preview what we can expect in Chicago the week of August 19th when the DNC kicks off their convention. Not just burning of the American flag, waving a Hamas flag, which since the late 1990s has been designated a terrorist organization by the United States. Also spray painting things like Hamas is coming around the U.S. Capitol. So this is going to unnerve moderates in the middle that are not going to like this scene. And that's really what Steve Eisman was getting at. And that is why he thinks Trump has the upper hand when it comes to November 5th.
You see that on August 19th at the DNC in Chicago. You'd imagine Democrats have got a big problem. That's the latest on that front. More on that a little bit later. I want to turn to China. There's been a rate cut again. The People's Bank of China unexpectedly lowering the cost of its one-year policy rate by the most since 2020. The first reduction in almost a year. The move underscoring China's growing urgency to support growth, which came in worse than expected in the second quarter. What do we see overnight in Asia? Difficulty for Japan off the back of a stronger Japanese yen. Chinese equities and that story's perked up a little bit from the lows of the last 12 months or so. But there's a growth problem, and they're struggling to respond to it.
I'm glad that you went to the market response. I was surprised we did not see an actual rally of any significance in Chinese bonds on the back of the biggest rate cut going back to 2020. That is typically the response that you would get. It raises a question of what is behind the growth scare. It is not necessarily a lack of borrowing available. It's not a lack of capital. It's a lack of demand. It's a lack of consumer spending. And so cutting rates won't attack that. And that really just highlights how much the market's aware of that and not responding to this in the same kind of way as it might have.
Puts even more emphasis on fiscal stimulus and the need for it. Goldman just yesterday talking about maybe Chinese authorities waiting to unload some of that for 25 to see the outcome of the November election. I want to turn to the automakers. It's been difficult for many of them. Shares of Ford slumping in the pre-market. The automaker posting second quarter profit that fell short of estimates. Quality problems the issue here that led to a jump in warranty costs. That stock is down by 13%. The CFO saying it was a one-time issue, insisting, Lisa, the company's heading in the right direction. I guess we'll see.
There are a lot of questions remaining. This is a warranty issue. They had one particular vehicle that did have a warranty, and people brought it in for a technical failure, and the cost was in the billions. Question is, what was behind that? Again, I keep going back to why are there these technical failures, issues? Is it a matter of personnel dating back to the pandemic? Is it something endemic? Or is this a matter of where do you focus at a time where consumers aren't buying electric vehicles as quickly as people previously thought? And so how do you go back to the bread and butter while also having a nod to the future?
I tell you, we'll try and answer some of those questions in about 40 minutes when we catch up with the Stellantis CEO exclusively on this program. That's the auto manufacturers. Let's turn back to big tech. Higher spending on AI programs and computing needs at Google parent Alphabet, prompting a sell-off in big tech stocks as investors look for more return on AI spending. One area companies are investing heavily is in data center capacity. Waldemar Szlezak is the global head of digital infrastructure at KKR and says two megatrends are driving the demand for data center capacity: migrating data to the cloud and the rise of AI. Waldemar joins us now for more. Waldemar, good to see you, sir.
Thanks for having me.
Thank you for being here. Let's just talk about what is digital infrastructure. Let's start there. Super simple. What are we describing here?
Yeah, it's a great question. I mean, I think to us, digital infrastructure really has three big pillars. There's mobile infrastructure. Traditionally, think of it as towers, telecom towers. There is the fixed line infrastructure, so it could be fiber that delivers connectivity to homes or enterprises. And of course, I think the topic we're about to discuss is cloud sort of storage and computing infrastructure, right? i.e. data centers, most pronouncedly. So those to us are the three big pillars, at least how we define digital infrastructure within KKR.
So let's talk about the investment opportunities and how much is going to be invested over the next several years. I want to reflect on a quote that came from the Google CEO, the Alphabet CEO, in the last couple of days, when he said the biggest risk here in a cycle with a theme like this is underinvesting and not over-investing. I sense from your perspective you're going to agree with that stance. Am I right?
Yes.
Why is that? Why is this such a big moment? And why is that the right way to look at the balance of risks?
Well, I think let's look at the computing piece, right, of it. I think two mega themes that we have are obviously under computing and last mile connectivity. And I think maybe we'll touch a little bit later on Metronet, which is a deal we announced yesterday in partnership with T-Mobile. But focusing on data center piece, I think if you look at United States and say, what was the infrastructure, what was the spend to help facilitate the build out of internet infrastructure or cloud infrastructure? So 16-year cycle from 1990 to 2006. 2 gigawatts. No longer do we think about data centers in terms of square feet. It's really about the amount of power that the data centers have. So that's an important factor there to consider. And we'll touch on that in a second. So internet infrastructure, 2 gigawatts. The next phase was Internet 2.0 and cloud, 8 gigawatts, about 15 years. Technology cycles have accelerated. So we're now talking about AI build-out, cloud 2.0, Internet 3.0 as a 5-year cycle and 25 to 30 gigawatts of power required to fuel this. So I think, you had a more patient, sort of highly visible investment cycle that's now gotten compressed, and perhaps it's creating, I think, scaring some of the investors out there.
Well, some people would argue that this might be one big reason for the sell-off we've actually seen in big tech. There was one investor who said this in a recent story. The overarching concern is, where is the return on investment in all the AI infrastructure spending? It'll pay off in a few years, but it's not going to come anytime soon. That is what the fear is. Waldemar, how much are you seeing near-term returns on some of these infrastructure projects that a lot of people would agree may be crucial in, say, 10 years?
Yeah, I mean, I think it's a great question. I would draw an analogy to similar questions raised during the build-out of cloud in 2006 and 2007. So, when Amazon really emerged as the cloud provider in 2007, I think similar questions were raised about where is the ROI. A tremendous amount of investment is needed to help facilitate the build-out before you actually start seeing the applications of that. And if you fast forward 2007 to today, Amazon stock is up almost 3,000%, right? And it's been forgotten. So I think the concerns are valid. I do think that there's frothiness in parts of the ecosystem. Within digital infrastructure, at least how we're positioning ourselves, we don't see that. Most of the capacity on the data center side that's coming online is fully leased. Most of it is leased to the large hyperscale customers. So the type of risks that we're looking to take, we're not necessarily exposed to perhaps some of the volatility. But I think it's a fair question to ask. What is the ROI? I think AI will be larger than potentially cloud. If you think about it, today, cloud business is about a $500 billion business annually, investing almost $200 billion to build that infrastructure. I think the view is that this feels different than late 90s, perhaps, bubble.
That said, you said that there are certain pockets that feel frothy and certain pockets that seem very worthy. What are those pockets? How do you distinguish the two?
Yeah, I mean, that's why I think we're trying to figure that out. So a big part of what we're doing at KKR is really trying to map the entire ecosystem from the silicon side, which is, I think, we're talking about chips, to the ultimate endpoint of applications layer, and trying to figure out how do we participate to the different strategies that we have within KKR. We're not a venture investor, so we're staying away from that. An interesting point I would make, in 1990s, a lot of analogies are being drawn to the 1990s tech bubble and bust. There were 38 or 39 stocks in 1999 that were up 100% in a year. Today, there's only one. So public markets, perhaps there isn't as much of a frothiness. Private markets, there's $15 billion of capital that has gone from venture capital funds into generative AI platforms. That's 10x the prior trend line. So I think perhaps there are parts of frothiness in the private markets versus the public markets. But I think we think of it as a long-term trend, sort of a Industry 3.0, if you think about it in terms of long-term 300-year sort of a cycle. And we're pretty confident that we're still in early innings of that.
When you look at the investment, is it actual market demand, or some of this has to do with the fiscal push coming out of Washington?
It's fundamental market demand. I think we're seeing government part of this investment has not played a large role. Now, we think that in the long term, I think a comprehensive solution, which includes private capital, includes obviously a combination of the tech companies, intervention from some government policies to help facilitate the build out of some of this power infrastructure, which ultimately is a key component of this, will be required. From a KKR perspective, we think of it as we're pretty uniquely positioned to ultimately play a major role in that.
So you just announced a deal. And
Yes.
it was actually not on highfalutin cyber prowess in artificial intelligence. It was in medium-sized, smaller cities getting connectivity, basic connectivity to the internet, to the cell phone. How far behind are we in basic infrastructure at a time where we're trying to build out a massive network?
Yeah, so two mega themes. We touched on the cloud computing. The other big theme we have is fiber to the home. We've made over 10 investments globally, over $10 billion of capital just in the fiber to the home strategies over the last decade. We're pretty bullish. We think this is pretty important. So in the US, about 50 million homes still don't have access to full fiber. We think that that's unacceptable and that ought to change. And so Metronet, which is the deal that we announced in partnership with T-Mobile, it's really meant to help facilitate the growth of that and really bridge the digital divide, not only in the sort of the, as you call it, the smaller cities, which, by the way, a smaller city in the United States called sub 50,000 population center has about the 1/5 of the speeds that you see in the major urban areas. And even in major urban areas, it's pretty inadequate. So I do think that we believe that there is a large decade-long investment cycle to help build out fiber infrastructure in the United States, and we're really happy to be part of it and happy to partner with a premier telecom operator like T-Mobile to do that.
You need to come back soon. We've only scratched the surface, haven't we? This was great. It's good to catch up with you, sir. Appreciate it.
Would love to.
Thank you. Waldemar Szlezak there of KKR. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Let's get over to Danny Berger. Hey, Danny.
Hey, John. The PBOC has unexpectedly lowered the cost of its one-year policy loans by the most since April 2020. Days ago, it also cut a key short-term rate to give greater support for a slowing economy. Now, taken together, those rate cuts amount to just a modest round of easing, which economists say is unlikely to move the needle in things like boosting domestic demand. Shares of Kering getting slammed this morning, down more than 7%, trading at the lowest since 2017. The owner of Gucci has warned that its profit will tumble in the second half of the year. Luxury demand is cooling and its turnaround efforts are sputtering. Kering has lost half of its value just nearly over the past 12 months. The company's market cap is now $37 billion. That is roughly 1/10 the size of its rival LVMH. And while luxury is struggling, so too are consumer staples this morning. Nestle down 4.5%. It cut its sales guidance for the year with consumers turning to cheaper food options. Revenue also disappointed, growing 2.1%. That's compared to 2.5% expected by analysts. Nearly all of that growth came from higher pricing, which also slowed sharply in the second quarter. The CEO on a call said that the company is still in repair mode and gross margins will still come under pressure thanks to higher costs of coffee and cocoa. And that's your Bloomberg Brief. John.
Things are looking tough over there, Danny, in both staples and discretionary in Europe. Up next on this program, we'll switch gears. Netanyahu staying the course.
For the forces of civilization to triumph, America and Israel must stand together. Israel will fight until we destroy Hamas's military capabilities, end its rule in Gaza, and bring all our hostages home.
That conversation up next. Live from New York, you're watching Bloomberg Surveillance. The equity sell-off going worldwide. See it in Europe, in Asia and Japan once again off the back of that stronger Japanese yen. Equity futures stateside after the sell-off of yesterday, down just a bit. We're negative 0.25% on the S&P. Under surveillance this morning, Netanyahu staying the course.
For the forces of civilization to triumph, America and Israel must stand together. This is an exceptional moment. Fast-tracking U.S. military aid could dramatically expedite an end to the war in Gaza and help prevent a broader war in the Middle East. Israel will fight until we destroy Hamas's military capabilities, end its rule in Gaza, and bring all our hostages home.
So here's the latest. Israeli Prime Minister Benjamin Netanyahu is set to meet with President Joe Biden and Vice President Kamala Harris later on today. Thousands protesting Netanyahu's visit to the US, including burning American flags. Julie Norman of University College London saying this: expect those eyes, close eyes rather, on Kamala Harris's Mid-East foreign policy comments this week. She's mostly had the administration's line, but is also seen as less personally connected to Israel than Biden. Julie joins us now for more. Julie, we'll spend some time about how these individual leaders, the president and the vice president, are going to navigate these two issues. Just want to sort of set the scene for where we are in the conflict at the moment, because it seems to change from day to day. Are we closer to a ceasefire or closer to a broader conflict? Just how finely balanced are things at the moment?
Yeah, John, I would say it's almost both at the same time. On the one hand, I think we are closer to a ceasefire than almost any time before. With that said, we've gotten close before and things have fallen apart at the last minute. So until it's a done deal, it's not done. I would say even with a ceasefire, though, this war is not just going to close down and go away. I think as we heard yesterday from Netanyahu and as we've heard from him for months, Israel will expect to retain a security presence in Gaza. There is still no real plan for a day after. And my guess is that we'll be looking at a sort of a insurgency, counterinsurgency dynamic for some time to come.
What needs to change to open up the negotiation for a ceasefire? Because Netanyahu's in the country, but there's a lot of reporting that he's the one that's been holding this back.
Well, that's right. And I would say there's been finger pointing both ways, again, for months now about who's holding it up. Right now, there are some elements that Netanyahu keeps pushing, and some say is slowing the negotiations. Those are some specific details, such as who's going to control the southern border of Gaza with Egypt, who's going to control that crossing, how will people move from south to north. But I think the crux of this is really what the tension has always been, the sense that Hamas wants to ensure this will lead to a permanent ceasefire and a full withdrawal of Israeli army and troops. And Israel wants to ensure that they can maintain some kind of security and military presence in the Strip. And those two things just keep coming to a head in some of the final wording.
Julie, as it comes to my understanding at this moment, there are 5 Americans still being held hostage by Hamas. Although yesterday we saw protesters in Washington, D.C., waving Hamas flags and burning American flags. How much of a gift are those images to the likes of Sinwar?
Yeah, so obviously the protests have been going on for months now, and I do think that they give some sense of support to Hamas, but also to Palestinians more broadly. With that said, I think a lot of the messages in the protests reflect just a small slice of many of who are taking to the streets around this. But I would say protests have been a big part of this in Israel as well, in terms of trying to bring the hostages home. And if anything, I'd say that is where Netanyahu is feeling the pressure more from the protests that have been ongoing within his own country.
It does put a spotlight on the differing views that are associated currently with respect to Israel from both the Republican Party as well as the Democratic Party. It is viewed in popular culture right now that Republicans are a lot more friendly to Israel than Democrats. And that's one of the reasons why you're seeing an increasing number of the Jewish vote actually shifting Republican, which is really the first time you've seen that in a long time. Julie, how is this reshaping the concept of the U.S. relationship with Israel, depending on whether it is a Republican or Democratic administration?
Yeah, Lisa, this was certainly part of Netanyahu's calculation with coming at this time. He sees the political landscape shifting, and I think he wanted to come and give this speech to really try and shore up that bipartisan support and almost challenge Democratic lawmakers to, turn their back on him. And I think the case that we heard him making yesterday was trying to appeal a bit more to bipartisanship than he has in a couple of his recent visits. And that was in trying to frame this conflict, one, in very moral terms, and two, in very strategic terms, saying this is civilization versus, barbarism. And on top of that, all this is nested within Iran, within other regional tensions, that the U.S., this is in your interest to keep aiding Israel. And I think that's the message that Netanyahu really is trying to get home this week to both parties.
One big question has been that currently we now have a lame duck president, that President Biden has about 4 more months left in his tenure, less than that, as he prepares for another administration, whether it's Kamala Harris or Donald Trump. Does that lack of another term, the lack of his being in the running, make it easier or harder for him to play a significant role in some of the ceasefire, some of the end to the conflict types of discussions?
Yeah, I think a bit of both. I mean, right now, we still have 6 months with Biden in office, and a lot of what's going to play out with the ceasefire, et cetera, in the short term is going to be under his watch. And that's one reason why this meeting today between Biden and Netanyahu still matters. At the same time, we all know, looking ahead, it's going to be a different leader after 6 months. And that's also why Netanyahu has to meet with Harris and with Trump and trying to get those relationships somewhat on track with him as well. But with Biden, I think it'll be interesting to see. Some are saying he might be a bit more open to tough talk with Netanyahu today, simply because he doesn't have re-election hanging over him. His strategy up till now has been what they call a bear hug approach, a sort of a public embrace, but private speaking a bit more frankly. And I think we might expect a bit more frankness today.
And that's an interesting assessment. Julie Norman there of UCL. Julie, thank you very much. Appreciate it. Just reconnected my mic there, I think. OK, we sorted. I think we're good. All right, good. I think your question's an important one. The lack of appreciable sort of like continuity around a key foreign policy issue, I think it's going to be really, really important here. If you think about 2 issues at the moment, Ukraine and Israel could have 2 very, very different partners come January next year. You mentioned Israel, Ukraine too.
Terry Haynes actually put out a note and said that on the margins, the speech was somewhat markets negative because he expects the increase in potential geopolitical tensions to result from that lack of continuity and an unclear sense of exactly how he plans to proceed.
And also what you have is Netanyahu going down to Mar-a-Lago to meet with Trump. There's been this narrative that Netanyahu wants to wait to get any sort of deal until Trump comes back into play. And we're going to hear a lot more policy leak out. This week I've reported that a Trump 2.0 might mean pushing NATO when it comes to Ukraine, pushing NATO to spend 3% of defense of their GDP, no longer the 2% he was hammering them for.
The second hour of Bloomberg Surveillance is up next. Coming up next on the programme, we'll catch up with Anastasia Amoroso of iCapital, Carlos Tavares of Stellantis, and Gurpreet Garewal of Goldman Sachs Asset Management, alongside Libby Cantrill of Pimco. From New York City, this is Bloomberg.
At a point right now where I think we can all agree the economy is slowing.
There is some evidence that some of that slowing in the macro data is starting to feed through to corporate earnings, and that creates a less constructive backdrop for stocks.
Policy rates today are restrictive. Why not have less restrictive policy?
To the market, what's going to matter most on all of these things is clarity. So long as there's clarity, the business environment will be able to handle it.
I gotta say, we've never had this intensity of debates between bulls and bears.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Coming off the back of the biggest one-day sell-off of the year so far on both the S&P 500 and the Nasdaq 2. From New York City this morning, good morning, good morning. Your equity picture looks a little something like this. Equity futures pulling back once again on the S&P by 0.1%, down just 0.2 on the Nasdaq. Think about the arc of the last month or so. Mohamed Al-Arian coming out and saying they need to cut rates in July. Jan Hatzius of Goldman saying, why wait? Bill Dudley, former New York Fed president, on Bloomberg Opinion in the last 24 hours, I've changed my mind. They need to cut interest rates.
And the change of mind was partly why markets particularly took this as an onerous and potentially problematic signal. It comes as there's a number of data points that have pointed to a weakening consumer, including credit card balances. That the share of credit card balances past due reached a series high in recent Philly Fed data, going back to 2012, at a time when it's clear that there has been a shift in consumer preferences. This is really the key. Weak or weakening?
Bill Dudley, 8:15 Eastern Time. Bill's going to have thoughts on that. Don't miss that conversation a little bit later on this morning. Think about where we've been and what's worked so far and what's unwinding now. We've described this, characterized things this morning as just a monster unwind of consensus positions across equities, bonds and foreign exchange. In equities, it's big tech selling off. Over in Europe, it's luxury. We see that again this morning. In Japan, what did you want to be in Japan? You wanted to be short the Japanese yen along the equity market. What's unwound? Exactly that. We're seeing this across the board in a really aggressive way. It is not just US tech. I think we need to be really clear about that. It is global. It is a series of consensus positions unwinding cross-asset.
Which is the reason why you're going to hear some people, including Max Kettner over at HSBC, say this is technical. This is not a matter of any kind of fundamental change. And people are trying to put a narrative around it. This has been the story for the whole year. We've all been trying to do that. Here's the question, though. At a certain time when, yes, that is true, these are consensus trades that are now suddenly underperforming after basically a hyperbolic move up, there are some real signals. We're getting some earnings, including from the airlines, that are hugely disappointing, including from some of the auto manufacturers, hugely disappointing. The commentary from executives also highlighting how consumers are pushing back. They're not spending as freely.
Max Kettner saying don't buy the growth scare, but I agree with you. Go to the earnings this morning. Nestle, talking about the cost of living crisis. Those consumers that were trading down at the moment, they're struggling to get them back. Look at the automakers. It is bleak when you look at autos, when you look at luxury. You thought potentially it was a higher end consumer that was going to keep chugging along. You are seeing cracks even at the higher end. It's not just the lower end that's trading down.
Well, let's talk about the airlines. Check out American this morning. Numbers just dropped. Stock does too. Down by more than 6%. New range, new outlook for EPS, 70 cents to 130. They had seen 225 to 325. Pre-market, at least we're down 7% in early trading.
Yeah, what they see right now is third quarter adjusted earnings per share about $0. It was expected to be about $0.50. You're looking at a situation where they're not able to pass along pricing increases to the consumers. The same story for Nestle, although albeit a different industry. They're seeing their margins squeezed. Is this just a consequence of inflation coming down, which is what a lot of people were saying? So it was less clear that they could pass it along to consumers? Or is this something different? And that, I think, is what's creating some issues in markets.
Sit on that stock. Just look at this move. We're down 9%. And think about how much lower the bar should have been for this company. We heard it from Delta. We heard it from United. Surely the bar was low enough going into earnings. And I think this really just shows you something. And we often talk about this. You can look at the information. That's one thing. And you can look at how the market responds to it. That's another. This is a really bad time to report bad news. We've seen that at the automakers in the last 24 hours. You're seeing it with American this morning.
It's a great point that essentially if you present something that is disappointing, you are unduly punished, especially if it is consumer facing. There is this sense that in the airline industry, there is a normalization or a rolling over in the post-pandemic kind of travel boom. Question is, how deep does it go? These are pretty bad. The idea of seeing full-year adjusted earnings per share 70 cents to $1.30 versus $2.25 to $3.25. That's a huge adjustment downward.
The airline business is a tough one right now, that's for sure. That's the latest on American. The broader price action, equity futures stateside settled down just a little bit. We're lower by only 0.1% on the S&P. The losses follow through from the US into Asia, into Europe. Europe's getting dragged down big time across the board over on the continent. In the FX market, we're seeing just a little bit, again, a lot more maybe, of yen strength against the weaker dollar. Dollar yen breaking down to the low 150s now at about 152. In the bond market, quite a scene for you. Big rally. Once again, we're down 6 basis points on 10s. Lisa, on 2s, we're down 7 or 8 basis points.
There's this expectation that the Fed's going to have to respond, and this is clearly baked into markets for September. Whether next week they cut rates is going to be a huge question. Mohamed El-Erian, in his column today, talked about how they probably won't, just because they want to signal and they want to create enough distance from the political process. But if they don't cut rates in September, this will be a policy error akin to transitory, if not potentially even more harmful to the U.S. economy.
I was catching up with Mike McKee in the newsroom a little bit earlier this morning before the programme started. He just said the market's already cutting rates for them based on some of these moves. They just have to validate it by giving a nod to September.
Maybe, but if they continue to come out with a certain rhetoric that they have patience and they continue this rhetoric that they don't expect to cut rates all that much next year, that could change the market's perception of the reaction function to a Fed that is looking at the same data that they are.
Coming up this hour, we'll catch up with Anastasia Amoroso of iCapital as the S&P 500 snaps its longest streak without a 2% decline since 2007. Stellantis CEO Carlos Tavares following a disappointing earnings report, and Pimco's Libby Cantrill as the 2024 presidential race heats up. We begin with our top story, a big sell-off in big tech, sending the S&P 500 to its worst day since December 22. Anastasia Amoroso of iCapital writes in this: tech consolidation and sell-off likely has more to go. Outperformance in terms of positive surprises led the significant Mag 7 stocks outperformance over the past year and a half. But it now may be coming to an end. Anastasia joins us for more. Anastasia, good morning. It's good to see you.
Good to see you.
What are we seeing take place here? Just a massive technical unwind of consensus positions across the board? Is it a growth scare, a rotation, a broadening gap? What is this?
Well, I think the technical backdrop is part of the story. And obviously, you know, the technicals were very stretched coming into, I would say, June for technology shares in particular, whether you looked at positioning, whether you looked at the overbought conditions. Remember, we were at the relative strength indicator over 70 for quite some time. So I think that explains part of the unwind. When you see a setup like that, you think, well, something's going to happen to take us down. But I do think also there's a more fundamental story here, which is the earnings surprises. As I mentioned, that's what really lifted the Mag 7 stocks higher. If you look at by how much they were beating expectations, that's one way to look at it. The rest of the S&P was not doing much, but the Mag 7 was doing a lot. The other thing to think about is how much were the earnings revisions going up for some of those technology stocks? And again, it's by a significant amount. That is not likely to be the case going forward. And case in point, Alphabet and Tesla did not see the positive surprises or saw a negative surprise. And to your point, the market is really severely punishing that. So you have lofty expectations, you have lofty valuations, and now you don't have the same surprise factor as you did before. So that's why I think investors will continue this unwind trade.
This is a very confusing market to me because on one hand, I believe in the sort of unwind story and then it doesn't seem so pernicious. It's just basically taking chips off the table, cashing in just technically for risk adjustment. On the flip side, I want to stick on American Air for a second, and I'm not asking you to comment specifically on this airline, but the fact that the shares are down so much, even after, as John was mentioning, being punished all through the year, it is down 26% year to date, really suggests that we're coming off really low expectations and still getting punished when earnings disappoint. Doesn't that reflect this feeling of sort of the unknown of how much and how quickly growth is weakening?
Yeah, but I think the expectations were probably not low enough coming into this quarter. If you think about how much the expectations typically get revised down, it's let's say 3 or 4%. This time around, they got revised down by all of 0.5%. So I don't think we really reset the bar substantially lower. And that's why going into the reporting season, one of the things we've been flagging is there's likely this disconnect that's building between the earnings expectations and what's happening in the economy. And if you look at the economic surprise index, it's been negative for quite some time. If you look at the U.S. consumer, Lisa, I think I'm now maybe finally joining you in that camp, that there's a weakening in the U.S. consumer, and there's the unemployment rate that did go up from 3.4% to 4.1%. That's not something to disregard. So I think that's the squaring that we have to do in the markets, is acknowledge the fact that earnings expectations were too high for the economic growth that we have today.
What does that mean for how bullish or bearish you are on, say, tech stocks, which you used to really love and you used to lean into? You said you can't just throw them out because everybody loves them.
Yeah.
At this point, are you looking to buy? Is this sort of a buyable dip, or is this something that you stay away from because you don't want to get in front of a freight train?
I think you don't buy just yet, or maybe you buy very slowly, but with the idea that this is likely to play out over the coming months. And, the reason I say that, Lisa, is there's this, Gartner's hype chart that I'm sure a lot of us and a lot of viewers have seen. And you go through this peak of inflated expectation cycle, and what's on the other end is actually the trough of disillusionment. And I'm not saying that we're necessarily going that way for all of the AI stocks, but I think for some of them we likely are. Or it's going to take longer to monetize the AI that we were all so excited about. So that's why I think that part is going to take a little bit longer to play out. The other part is just given how long investors have been some of these artificial intelligence stocks, I think there's still a lot of selling pressure that is likely to come forth. So that's why I would think about having a shopping list, but executing that shopping list probably over the next few months. The other thing, too, the markets typically consolidate into the first, or I should say after the first rate cut. So whether it's July, whether it's September, the markets 3 months after the cut tended to consolidate. Information technology, if you use the 1995 cycle, for example, as a soft landing scenario, Infotech rallied into the first rate cut, but again, it's sold off or consolidated after. So that's why I don't think it's a quick buy the dip here in technology, but think about it as more of a protracted, let's say 3 months consolidation frame.
Given you've now come on to Lisa's side about these concerns in the consumer, where will that play out in the market? If consumers aren't spending, what does that mean for potentially stocks you want to go in on or pull back?
First of all, what I would say, the consumers are spending, right? But they're not spending as much as they used to. If you look at credit card spending data, for example, if it was up 7 or 8% year over year, now it's maybe 3 to 5%, depending on what kind of a consumer you look at. So I think it's a slowdown story versus a recessionary consumer spending print. But I will say, Anne-Marie, that one of the favorite trades that I have in the market today are the rotation trade, which is the other side of the technology trade, which is going to things like regional banks, for example. So it's probably not as levered to the consumer as it is to the commercial real estate market, for example, but regional banks are really levered to lower interest rates. I think the one certainty that we have in this market environment is the Fed is likely to cut rates, if not this month, then probably in the next couple of months. And if that's the case, you want to go to those rate cutting beneficiaries. If you have lower rates, then some of those unrealized losses on the balance sheets of those banks should maybe become less so than they were before. If you have lower rates, you should also have better income margins, net interest margins for those banks. So that's where I would be looking to position in regionals, in small caps, and utilities, which all of those sort of avoid the consumer.
Smalls outperforming this morning. Equity futures on a Russell up by about 0.2%. Just an observation, more and more people sort of shift into Bramo's camp. on the consumer. You notice that? They always pointed you. They're like, I'm in your camp
it's
now.
Sort of like,
it's like you run the camp.
I run the camp of sort of vague pessimism and sort of gloom and doom. I think about the 60-40 on Sebastian Page's allocation committee, and basically the bond people are on one side, the equity people are on the other side, and there's sort of a cloud hanging over bond people, and equities are like,
without a doubt, you are a bond person. Anastasia Amoroso of iCapital. Anastasia, thank you. Appreciate it. Let's get you an update on news elsewhere with your top stories in your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of American Air down some 8% in the pre-market after reporting a short while ago. They beat on second quarter earnings, but they did slash their guidance for the full year. It originally saw adjusted EPS coming in at $2.25 to $3.25 for the year, but it's lowered that to just 70 cents to $1.30. The airline saying that they, quote, did not perform to initial expectations due to their prior sales and distribution strategy and an imbalance of domestic supply and demand. Shares of Universal Music Group also plunging in the Amsterdam trade, down 25%, the biggest drop since their IPO. The world's biggest record label, which represents Taylor Swift and Drake, reported subscription and streaming revenue that fell short of analyst estimates. It was a slowdown in streaming platforms and adding new subscribers that ultimately hit revenue. Meanwhile, a dispute with TikTok and licensing changes for Meta also hurt them in the quarter. The NBA has announced new long-term contracts for TV with Walt Disney, Comcast, and Amazon, spurring long-standing partner Warner Brothers. The league rejected Warner's bid to match Amazon's offer of about $1.8 billion a year, setting up a potential legal battle. The new agreements are set to generate $76 billion in fees over the next 11 years. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, automakers under pressure.
We're working on reducing our costs intensely. It's an incredible focus by the team. Really, it's quality and cost reductions. That's our opportunity in the near term to really improve the business. We're going to look to, accelerate that progress.
That's the view from Ford, the view from Stellantis. Up next.
The Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom. At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
I do love a Lisa promo. Just some of the best. Look out for the
Election that's
Federal
going
Reserve.
haywire.
Sort of a long list of things there, Lisa.
I need to really kind of sit back.
Don't sit back. We love it. Equity futures on the S&P pulling back just 0.1%. Under surveillance this morning, automakers under pressure.
We're working on reducing our costs intensely. It's an incredible focus by the team. Really, it's quality and cost reductions. That's our opportunity in the near term to really improve the business. The team's focused on it. There will be additional cost reductions. We're on track to take $2 billion in material cost out, manufacturing costs, freight costs, and we're going to look to, accelerate that progress.
Here's the latest this morning. Auto earnings reflecting some big challenges for the industry, with Ford and Stellantis delivering disappointing results. Stellantis opting to bring back old models and weighing price cuts after a massive drop in sales during the first half of the year. Joining us now to discuss, the Stellantis CEO, Carlos Tavares. Carlos, great to catch up with you, sir. Difficult morning for the stock. We're down about 8%. You know that. I want to talk about some of the brands. I'm not sure how many people recognize or realize how big this company is. So just give me a couple of seconds to go through this. At the premium end, you've got the luxury brand like Maserati. Then you've got Alfa Romeo, Lancia. You've got Jeep, which of course is well known here in the United States. Chrysler, Dodge, Ram. Over in Europe, Citroën, Fiat, Opel, Peugeot, Abarth, which of course Abarth is part of the Fiat business. This goes on and on and on. And I'm trying to work out this morning, Carlos, whether you're committed to all of that lineup, those brands, or whether some of them could be cut and spun off.
Well, there is, first of all, you are right to say that the automakers are under pressure. The auto industry is in a turmoil, and as you are looking at the results, everybody is going in the same direction. And for the time being, as much as I am aware of, we are the only guy in town with a double-digit AY margin. But you are right, we are under pressure. And to your question about the brands, there is no taboo. There is absolutely no taboo. The brands are intangible assets that we respect. We believe that they are here to be leveraged. We could celebrate this year the 125th anniversary of Fiat and Opel, which demonstrates that the brands are stronger than the legal entities, stronger than the political regimes, and they can cross wars, survive, and get better. So we do respect the brands. We respect the fan basis of the brands, but there is no taboo. If they are not able to monetize the value that they represent, then decisions will come. For the time being, all of our brands, with no exception, are profitable. It is not by chance that we are a 10% AY margin car company, the only one to be double digits so far. It is just because our brands are great. Our products are very appealing, and I will just use the example of our Ram pickup trucks, where we were again #1 in the GD Power quality survey, which means that our customers appreciate what our creative people are bringing to the market. Now, it is true that the market is in a turmoil. It is true that the transition that we are going through is immensely challenging, and this is a bump. There will be other bumps. This will last for a few years. This is not a short-term turmoil. And the most resilient, the most focused, the most customer-focused will survive, of course. And that also means, because that's what I'm hearing, that cost reduction is not becoming a taboo anymore. As you know, we have been working hard on cost reduction for many years. We have not been so popular, but now everybody recognizes that the customers want affordability. The customers want a safe, clean, and affordable mobility. So that's my comment to your great question. Thank you.
There's one question about cutting the cost of the vehicle. There's another question about cutting costs internally to offset some of the increased expenses. Shipments in North America fell 18% in the last quarter, and I'm just wondering whether some deeper cost cutting, to John's point, is required to sort of bring that up to speed at a time where the EV transition isn't happening as quickly as people had planned for.
Exactly. And what you are saying, you say, is not happening as quickly as the people had planned for. I would like, with all the respect, to correct that. It is not happening as quickly as the political leadership had expected. What we are seeing in the Western world right now is that the consumers are not supporting as much as the political leadership was expecting the EV ramp up. And the consumers, they are very clear in what they expect from us. They expect safe, clean, and affordable mobility. And safe and clean they are, affordable is the challenge. So they want basically to buy EV cars at the price of internal combustion engine cars. They don't want to pay more for the EV technology, which I can totally understand. And I want to tell them that we are working super hard to achieve that. And we already have evidence that we are succeeding, because we started to launch our first B-segment EV cars from 20,000 euros, a little bit more than $20,000. And we will bring to the US market in a couple of years a Jeep model below $25,000. So yes, we hear what they say, and we are working super hard to deliver that. And indeed, the political leadership through the regulations thought that the consumers were able and willing to pay a higher price for EVs. And they are telling us, the consumers, that they don't agree with that. And we are in the middle. We are the fuse between the consumers and the regulators. We are trying to fix it. And of course, it's difficult. It's difficult,
Carlos,
it's painful.
In January, you said you were going to hold off on some of your investment in the United States because you wanted to see how the election played out. But are you basically saying now it doesn't matter who gets elected because the consumers are rejecting the government push towards the EV models?
Well, that's not exactly what I am saying. It's a little bit more complicated than that. What I'm saying is that we have received loud and clear the message of affordability that the consumer is asking us to deliver on EVs. The sooner we get there, the faster we are going to ramp up. And the investments in EV technology are already done. What needs to be done now is the investments in the capacity for the volumes. So the investments in the capacity will be staged in function of the adoption by the consumers, and the adoption by the consumers is going to be a function of our ability to bring affordable vehicles to the market, which we are right now doing. And I think it's going to have a few bumps on the road. That's nothing specific or nothing surprising. It is going to be a bumpy road, and we will adapt the capacity investments to the adoption rate of the consumers, which is going to be the consequence of affordability. That's where we are. And we are bringing a lot of proof points that we are achieving that, starting with the European market right now, but it will come very soon with the US.
Carlos, how difficult is it to compete right now with Chinese auto manufacturers who really have a leg up in providing affordable electric vehicles and are able to export some of those to Europe? Right now, there are gates in the US. Are those gates positive or negative for you at a time when you're a global car business?
Well, that's a great question. As we are a global car maker, and it was pointed out that we had a 14 plus one brand. The plus one is a Chinese brand, Leapmotor. So yes, we have 15 brands, and we are a global car maker. So as a racing team we need to recognize that being global means that we will not be protected everywhere. For instance, we are not protected in Latin America. We are not protected in Africa, Middle East. So as a racing team we need to confront ourselves with the harshest competition. Right now, the harshest competition is China, and they have a 30% cost competitive edge against us, ex workspaces. And we are working hard to recover those 30% cost competitive handicap that we have. And it's good for a company like ours to be competing with the harshest competition. That keeps us awake, that keeps us alive, and we need to run fast and even faster to compete. Then when we come to protected markets, we have to realize that there are a lot of side effects and collateral damages to protected markets. And that protection that may be nice in the short term may have enormous disadvantages in the mid and long term. And that's why we do not advocate custom duties. We have to fight against the best. We have to make ourselves better in quality, in appeal, in cost. This is the way we can survive. And we used to say at Stellantis, the only thing that protects us is performance, and we deeply believe in that.
If that's the case, does that make it harder to keep a production base in places like Italy?
It makes us harder in the Western world, indeed. But in the Western world, we have more knowledge, more experience. We should use our education, our scientific education, our capability to work collectively to find paradigm breakers to compete. It is possible. The 23,000 euro mid-trim EC3 Citroën is made in Europe. Of course, in the lowest cost countries of Europe, but it's made in Europe. It's made inside of Europe.
As you know, sir, the reason I ask is because there are some Chinese producers looking for a manufacturing base in Italy. You, of course, have some production bases there. I wonder if you'd be interested in selling them.
Well, it's a public information that all the European governments are dating the Chinese car makers to come to assemble their vehicles in their countries. So all the European countries, Italy, France, Germany, Spain, they are all dating the Chinese. Fine. So that's a fact. So if you were to ask me, which is possibly your question, would I be willing to sell one of my plants to the Chinese? I would ask you back a question. What is the intention of the European Union if we are encouraged to sell our plants to the Chinese? What would be the sense and the purpose of inviting the automakers of Europe, which represent 14 million jobs, to hand over their plants to the Chinese. Does that make sense for the European citizen? Of course, it doesn't make any sense, which of course we know. So, of course, all business is business. We'll see what the future will bring, but we are here for the fight. We are here to demonstrate that we have more appealing brands, more exciting cars at the right level of affordability, with the right performance and the right safety. So we are going to fight. This is a competition. We love competition. And everything we do for Europe, because the market is much more open than US market, in terms of competitiveness of our technology, will benefit our American brands, because Stellantis is a global car maker and the technology is available for the 15 brands of the company. Anything we do to compete with the Chinese in Europe or in the rest of the world will benefit, of course, our US brands to bring affordability and performance as soon as we can to this market.
Carlos, you've been super generous with your time. I just want to return to my original question, though. The way you posed your response to that, the conversation that I would have with a policymaker for the good of the European economy and for the good of European labour is a very different one to the CEO of an auto manufacturer. You, of course, are accountable to the shareholder, and the stock is down by 9%, as you know, today. This is a difficult day for Stellantis. So when I ask you a question like, would you sell a production base in Italy to the Chinese? I'm not asking you that as a public official who needs to worry about the size of the European labour market. I'm asking you that as a CEO of Stellantis. Is that a good financial decision for you to make?
It depends if I am making profit out of that facility or not.
Well, you're under capacity there, aren't you?
I will make sure that we keep the capacity above 80% utilization rate. That's the threshold. As long as you are above 80%, you can do a good job.
And you're confident you will be for the next 12 months and beyond?
This is one of the things we have been discussing with the Italian government. They keep on asking us to have a 1 million car production, and I keep on answering that I need 1 million customers. The point is not about the production. The point is about the customers. Now, it is quite clear that if you have 1 million customers out there, and you have to break down the 1 million customers among a certain number of car makers, if you increase the number of car makers competing for the same 1 million customers, it is easy to understand that there will be less cars to be produced. And that is going to open the road to a new context. And in the new context, we'll see what are the decisions we need to make. But at the end of the day, it all boils down to something we know very well in the US. Make the customer happy, period. It starts there. Good quality, good appeal, good affordability, and then you will capture the share of the market that you deserve. And if you don't compete with the harshest competition, then forget it. On the long run, you are going to disappear. There is no other way than to compete with the harshest competition at any point in time.
Carlos, I can tell you this, I'd be very happy if there was a Maserati on my drive, OK? We can leave it there. Carlos, thank you, sir. Appreciate your time. I could talk all day with you. Appreciate it. Carlos Tavares there, the Stellantis CEO. Just a wide-ranging conversation about how difficult it is for an auto manufacturer right now, a global one, when you've got to deal with the politics, the politicians who are looking for one thing, and you've got to deal with the economic reality of where the consumer is at the moment. The tension, the push and pull there, you can feel it. I think Carlos did a wonderful job of really laying that out for us in a very honest, transparent way of how difficult things are right now.
Especially given the fact that he said that Chinese auto manufacturers have a 30% advantage on them when it comes to a cost base of production at a time when a lot of government leaders are trying to figure out how to get around this. His response is the levies, the charges that people are talking about, the gates are not helpful and have corollary side effects that people will not like.
He's climbing two different hills at the same time. One, China, the other, internal politics, whether it's Western Europe, whether it's the United States, this political hope of this EV transition happening quicker than it currently is. And the consumers, he said it right there, are rejecting it. They're rejecting it at the moment.
If you are just joining us, welcome to the programme. Got some things to get through, so let's start with the price action. Equity futures on the S&P negative here by about 0.1%. Bit of a pullback again on the Nasdaq. In the bond market, this big rally that started to emerge at the front end of the curve, it continues. And it continues through the curve. We're down 6 or 7 basis points on twos to 436.47. Down about 6 on a 10-year to about 422. The curve just a little bit steeper. The difference, the distance between a 2-year and a 10-year right now, about 14 basis points. In foreign exchange, all eyes on the Japanese yen. 4 consecutive days of yen strength, the longest such streak going back to March. Dollar yen at the moment, 152.39. Under surveillance this morning, some top stories for you. Israel's Prime Minister Benjamin Netanyahu making his pitch to Congress, defending Israel's war against Hamas and calling on the United States to fast-track military aid. He's set to meet with President Biden and Vice President Kamala Harris later on today. The share of US credit card balances past due reaching a series high in a Philadelphia Fed gauge dating back to 2012. Lisa, you mentioned this earlier. 2.6% of balances were 60 days past due in the first quarter. That's up from a low of 1.1% back in 2021.
The problem with sort of extrapolating out too much from this data is just that it's still pretty low at 2.6%. That said, the trend is remarkable. And the fact that we haven't seen this type of trend is something a lot of people are taking note of. It's the reason why jobless claims today at about an hour time are going to be so crucial, and tomorrow personal income and spending also really setting a tone.
Let's go through that list of data that we get in about 60 minutes. So jobless claims one, US GDP another, durable goods data all due in about less than an hour from now. Gurpreet Garewal of Goldman Sachs writing this in her Q3 fixed income outlook, where we recognise sound economic and corporate fundamentals, we remain vigilant due to stretched valuations and political uncertainties. Gurpreet joins us now for more. Gurpreet, thanks for your patience and thank you for being with us. I want to go straight to this slowdown that we're starting to see emerge, just a sign of it in some of the earnings and some of the pushback we've heard from a former Goldman Sachs colleague, Bill Dudley, of course, former New York Fed president as well, who's come out in the last 24 hours and says the Fed needs to get a move on, that we risk a recession here if they don't cut interest rates. What's your stance on that? How are you and the team thinking about the balance of risks around the Fed's timing of its next move?
Hi, Jonathan. First of all, great to be with you. Look, I would say, we agree the Fed is data dependent. And if that is the case, the data right now does seem supportive of a rate cut. You've had inflation cool down. The disinflation has resumed after a setback earlier in the year. We're seeing a cool down in the labor market. It's not necessarily collapsing. You've seen relatively resilient spending. Retail sales and industry and production data recently surprised to the upside. But on the whole, the data does appear consistent with normalization and pulling back that restrictive policy. Also, if you look at Taylor rule formulations based on the output gap and inflation, they also suggest the Fed should have cut by now. But of course, this is not a textbook economy. What may make sense in theory may not actually be delivered in practice. And our base case assumption is that the Fed is probably going to wait until the September meeting, not next week, to deliver the first cut in this cycle. And, one of the reasons for that is, first of all, they just want to accumulate more confidence in this disinflation path. The second is, at that point in time, they will unveil updated statement of economic projections, the updated dot plot. Back in June, those projections showed PCE inflation, core PCE inflation, higher than where it is at the moment. We have the latest data coming out tomorrow. Also showed only one cut projected on median relative to 3 back in March. And so if they're able to unveil updated economic projections and then explain the start of this gradual easing process, we think that's what would be their preferred choice.
Gurpreet, I hear a lot of words. Normalization. I hear about the idea of adjusting restrictive policy. I'm not hearing recession. I'm not hearing anything that suggests that this is going to be just a period of time in a very dramatic downturn in the U.S. economy or the labor market or anything else. How do you decide when the market's gotten ahead of itself in pricing in rate cuts, not just this year, but also next?
Yeah, I think on your first point, the data right now does seem consistent with an adjustment cutting cycle. It's not as if the central bank is needing to cut because you're seeing a sudden slowdown in hiring or sudden uptick in layoffs. You're seeing that gradual cooling. Now, I would caution, our colleagues in Goldman Sachs Investment Research have also highlighted this, that the labor market has rebalanced back to where it was pre-pandemic. And so any weakening from here warrants close attention. But Chair Powell has also told us this. They have noted that the balance of risks to both sides of the mandate are in close focus. I would say right now, what we think is interesting is that you are going to have this gradual easing cycle that is beneficial for fixed income investors. Fixed income yields are going to start to look attractive relative to what you earn on cash. And so that's going to be very supportive for fixed income. I think to your point about what does it mean from here on out, there's a lot of uncertainty for the path in 2025, but I think there's definitely interesting opportunities opening up in the global opportunity set for interest rates, because whilst the response to the pandemic and then the response to the inflation driven by the pandemic and energy shock was largely synchronized, there is no one-size-fits-all approach to these easing cycles, and that's creating interesting opportunities.
Gurpreet, let's develop that idea, because there is this feeling typically that when a central bank cuts rates, it's a good time to go into those debt markets because essentially they're supporting them. So are you going into Chinese bonds? It doesn't seem like people were that enthusiastic with the rate cut over there.
Yeah, look, we look at EM and DM space very differently. I think globally, this concept of focusing on country-specific factors is what is going to drive the opportunity set. In China, you have a different macro regime. You're trying to address structural issues. I think in the EM space, the opportunities are actually more in markets where we have more confidence that the central bank is easing in response to improved inflation progress. And so, Hungary is one space. We saw a cut this year and other areas as well. And I think in the developed market space, there's greater opportunities in places like Canada. We saw the Bank of Canada become the first developed market central bank this week to deliver consecutive rate cuts. But there's also central banks on the other side of the spectrum in the developed market space. Bank of Japan, steady normalization. Reserve Bank of Australia, unlikely to cut anytime soon. So definitely an interesting global opportunity set, both in DM and EM, and it's driven by country-specific factors.
You say in the coming months you want to reinforce the importance of diversification to mitigate risks. What else could you do in that space to diversify?
Yeah, look, that's a great question. One of the things that we highlighted in the outlook is that you do have strong fundamentals. The economy is still relatively resilient. We're focused on what the picture is of corporate balance sheets as a result of the latest earnings seasons. But of course, you have tight valuations, you have policy uncertainty. And so alongside diversified exposures, be that your rates exposures within credit sectors, other strategies to boost portfolio resilience can include being overweight the US dollar, tends to be a beneficiary when you have these risk-off periods. Another potential option is to utilize currency options. That's a cost-effective way to position for potential pickup in currency volatility around any associated policy uncertainty. And so, diversification, active security selection, plus those strategies to boost portfolio resilience are all the best way for our clients' portfolios to be resilient to this uncertain environment.
Gurpreet, super smart. It's fantastic to get you on the programme. Let's do it again soon. Gurpreet Garewal there of Goldman Sachs on the latest in the fixed income market. High yield spread still in and around 300 basis points. That's super, super tight. Max Kettner of HSBC made that point on this programme earlier on this morning. We were talking about big unwind you're seeing in stocks, big rallies you're seeing at the front end of the curve in the bond market, big rally you're seeing in the Japanese yen, stronger yen, and you're thinking about risk aversion. Not seeing spreads get wider at all, are we?
You asked a question yesterday, and this to me is the key question. Is this predictive of strength, or is this basically an asset class that has lost its predictive ability with respect to a credit cycle and with respect to economic weakening? And I say this because private markets have offered this huge cushion so that what's left in public markets tends to be higher quality, and people are looking at the all-in yields in a way that is different and really changes the spread characterization going forward.
If you think about the conversations that you and I used to have to go together literally more than 10 years ago on Bloomberg TV, I'm aging us here, I'm sorry. We talk about how cyclical the index was, this big energy tilt. Do you remember that?
Yeah.
It's changed a lot in the last decade.
Yeah, it's actually shrunk dramatically. And think back to 2014, 2015, energy, shale, that was so stress tested that a lot of those names were kicked out, bankrupt, et cetera. The ones that survived were much stronger. The ones that have continued to be in that index tended to have been the survivors. And that is the reason why, yes, you are seeing a gapping out in the lowest quality of names. But other than that, you see some of the tightest spreads going back years.
Get told repeatedly all the time by a lot of people in this market, it's a high quality index. It's changed over the last few years. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. IBM shares up more than 2% in the pre-market. It reported a jump in its bookings for its AI business. IBM says bookings for AI consulting and software since mid-2023 have now exceeded $2 billion. Second quarter sales increased 2%, almost $16 billion. That beat the average analyst estimate. Boeing has agreed to plead guilty to criminal conspiracy over two fatal crashes of its 737 MAX jetliner. Details of the plea deal were made public in a federal court filing yesterday. in that agreement, Boeing faces a fine of at least $243 million. It will serve 3 years on probation with an independent corporate monitor. Boeing will also spend at least $455 million to bolster its compliance and safety programs. The Justice Department said Boeing violated a deferred prosecution deal after the blowout aboard an Alaska Air 737 MAX 9 jet on January 5th. And it was a chaotic finish, to put it lightly, to the opening match of the Olympics men's soccer tournament. Down 2-1 to Morocco, Argentina appeared to score a dramatic equalizer in the 15th minute of injury time. Morocco fans then stormed the pitch to protest the goal, and the match appeared to end in a 2-2 draw. 90 minutes later, with the stadium empty, news broke that Argentina's goal had been ruled offsides. The players then returned to the pitch to play the final 3 minutes. Morocco held on to the 2-1 win. And that's your brief. John.
I think the New York Times called this a circus, and I think that's fair to say that's what it was. Danny, thank you. Up next, Trump versus Harris.
We have a new victim to defeat. Lion Kamala Harris. Lion. L-Y-I-N apostrophe.
These extremists want to take us back, but we are not going back. We are not going back.
From New York City, that's up next. Equity futures on the S&P 500 negative here by 0.2%. Rally in the bond market, yields lower by 6 basis points. 422, 32 on 10s. Under surveillance this morning on the politics, it's Trump versus Harris.
We have a new victim to defeat. Lion Kamala Harris. Lion. L-Y-I-N apostrophe. The most incompetent and far left vice president in American history.
I believe we face a choice between two different visions for our nation. One focused on the future, the other focused on the past. These extremists want to take us back, but we are not going back. We are not going back.
So here's the latest. Donald Trump ramping up his attacks on Kamala Harris, criticizing her record as San Francisco district attorney and her stance on abortion rights. Harris taking aim at Trump and the GOP's ties to Project 2025. Libby Cantrill of Pimco saying this: while Trump remains favored to win at this point, his chances, as well as the odds of a Republican sweep in Congress, are now lower than they were just last week. We now view the election as more dynamic, with likely more twists ahead. Libby joins us for more. Libby, I can't imagine what those twists might be, so let's not even entertain that. I've got a poll in front of me. It's just dropped, so allow me to share it with you. It comes from Emerson College, and it reads as follows. It's on swing states. In Arizona, 49% support for Trump, 44% for Harris. Georgia, 48% support for Trump, 46% for Harris. In Michigan, 46% for Trump, 45% for Harris. Pennsylvania, 48% for Trump, 46% for Harris. Wisconsin, they are tied in Wisconsin at 47% support, Harris and Trump, respectively. When we start to get polls like that, more polls like that in the coming days and weeks, how much weight do you put on them in the early days and weeks of this contest?
Yeah, so I would say that not a lot right now. I think that the polls will be much more telling if, after the convention and then really in September. And this is what we have been telling clients even before all of this drama, is that really wait until September, because that's when just statistically polling becomes more predictive. Obviously, polling's never going to be completely clairvoyant in terms of who actually shows up to vote, but it becomes more predictive as you get closer. So, and I say especially this because it is so dynamic, because she really is reintroducing herself to voters. That's good and that's bad. I mean, she has a very progressive record that she ran on in 2020 that she's going to have to sort of defend and clarify and what have you. But I wouldn't necessarily. I would take all of this polling with a big grain of salt. So really, after the convention, really wait until September. I always tell clients, like, have a cocktail, go to the beach, enjoy your vacation, and then come back to politics in September, because that's actually when I think it's really what will be much more indicative.
It's hard to have a cocktail given the past few weeks that we've been dealing with in U.S. politics, but now there's a lot of emphasis on who she's going to pick as her running mate. Who do you think is best for her? Not just to support her and expand her views, because you say she is very progressive, but also the math when it comes to Electoral College.
Yeah, and so, I mean, is she very progressive? We don't know. I mean, just to clarify, I mean, she ran on a very progressive platform when she was running the Democratic primary. Yeah, yes, no, and she was running for national office even when she was in the Senate. So for sure, she has a progressive record. I think that's the thing, though, it's unknown about her is where does she stand on many of these issues. But you're absolutely right. Her running mate is going to be a really, really important, both because it is sort of the first public decision that she is going to make, and oftentimes, picking your running mate is really a reflection of the top of the ticket's judgment, but also, as you talk about, is really the Electoral College strategy. Arizona, as John just said, I mean, she's lagging in Arizona. Mark Kelly, the senator from Arizona, who's more moderate, particularly on border issues, that's going to be a big liability for her, but also could help shore up support in Arizona. And then Pennsylvania. I mean, if of all those 6 states that you just mentioned, Pennsylvania is going to be the most critical state for if Democrats are going to win. They have to win Pennsylvania. And it's necessary, but it's, necessary but not sufficient. I mean, they will have to win other states as well. But if they lose Pennsylvania, Democrats have lost this race. So Josh Shapiro, the popular governor, who also has a more moderate stance on things like fracking,
which she had said she was going to ban. So
exactly. And she says she's talked about Medicare for all. She's talking about defunding the police. She's talking about banning fracking. I mean, again, she has a platform that will be untenable for her to run on and win. And that's why I think she will need to start clarifying much of that. Now, the other challenge is that she's vice president and current sitting vice president, and she can't necessarily distance herself so much from Biden as well. So she has a lot of challenges, a lot of twists and turns ahead in terms of really navigating the policy front.
You said the top of the ticket is the judgment of the candidate. What does that say about Trump and his pick of J.D. Vance?
Yeah, well, as we were just talking about, I mean, this decision to pick J.D. Vance was really a moment in time, right? It was on the heels of the assassination attempt. It was when Biden was still in the race. It was when folks had odds of Trump winning at 75, 80%. Republican sweep looked more likely than not. And so he wasn't necessarily as concerned about expanding his voter base. He wasn't as concerned about it as being tight as it might end up being. So, we'll see whether he, how he feels about that J.D. Vance, but it is much more a doubling down on kind of MAGA and on Trumpism than, say, a Doug Burgum or even a Marco Rubio or certainly a Nikki Haley, some of the other folks who were in the mix.
So you note that Michelle Obama is still not going to be the nominee for
I saw that in the notes.
Okay. So sorry to break it to you.
It was a digital hold on a second. Well, but hold on a second.
I wondered who that was for.
Okay, evidently that was for us. But I'm not going to ask you about Michelle Obama. I don't think that I was the genesis of that. I do want to ask you, though, about the tenor of the discussions that you've been having with clients overseas, outside of the U.S., how they're viewing this, how that affects their investment decisions, what questions they're asking to understand the potential ramifications of this.
Yeah, so actually, I'm still getting questions about Michelle Obama from our Asian clients and about Jamie Dimon. So, hope springs eternal, I guess. So I would say they're sort of in 2 lanes. One is around fiscal. And of course, a lot of our clients overseas have a lot of dollar and a lot of treasuries exposure. So just trying to navigate that. And I think, as we've talked about, really the punchline here is that the deficit is the biggest loser in November. So regardless of who wins, the deficit will remain high. And not only because there might be new spending and there might be more tax cuts, although I think that's going to be difficult just given where deficits are right now, but mostly because, as we've talked about, there won't be entitlement reform, and that's what you really need in order to, to consolidate sort of the budget and what have you. And the other concern they have is, of course, around geopolitics. And interestingly, mixed views here, because I think a lot of folks in Asia think that, well, at least President Trump, we can negotiate with him, whereas maybe a Biden or Harris may have more of an ideological view. So I'm not sure that's right. I mean, again, I think the direction of travel here around tariffs, around export controls, around even capital flows, around scrutiny around how U.S. investors invest in China is going to be sort of pervasive regardless of who wins. So in some ways, my view is there may be fewer distinctions than folks think, but that's really where our clients are focused.
The message from Pimco: get a cocktail, enjoy the beach.
Yeah,
sort of
that's what she tried last week. How'd that work out?
Yeah, I mean, not well, I will tell you. Yes, this is what I'm trying to do. It's sort of self-soothing, but it's not really working out very well.
Thank you. I like that advice.
Libby, it's good to see you. Thank you.
Thanks.
Libby Cantrill of Pimco on the latest. Coming up in the next hour on Bloomberg Surveillance, we'll catch up with Cameron Dawson of NewEdge Wealth. We'll speak to the former New York Fed President, Bill Dudley. Bill, in the headlines in a big way in the last 24 hours with a big call to cut interest rates this month. Bill's just around the corner, as is Michelle Girard of NatWest Markets and Gennadiy Goldberg of TD Securities. Your equity market on the S&P 500 slightly softer. Been a difficult week from New York. This is Bloomberg.
We're at a point right now where I think we can all agree the economy is slowing.
There's some evidence that some of that slowing in the macro data is starting to feed through to corporate earnings, and that creates a less constructive backdrop for stocks.
Policy rates today are restrictive. Why not have less restrictive policy?
To the market, what's going to matter most on all of these things is clarity. So long as there's clarity, the business environment will be able to handle it.
I gotta say, we've never had this intensity of debates between bulls and bears.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
What a 24 hours it's been in this market, and it continues. So let's pick up on some of the price action for you and start in the equity market. Futures negative here by 0.25% on the S&P, following the biggest one-day loss going back to 2022. Likewise on the Nasdaq 100, down by about 1/3%. Just a little bit of weakness, nothing too dramatic. In the last 24 hours, though, big rally at the front end of the yield curve. The 2-year yields lower again this morning. So let's talk about the why. We could talk about the data. It drops in about 29 minutes. I think we need to talk about the commentary coming from a former Fed official, former New York Fed President Bill Dudley, who says he's changed his mind. They need to reduce interest rates this month. Bill joins us in about 15 minutes' time. Do not miss that conversation. And it's hot on the heels of a conversation we've had with Mohamed Al-Erin a few times on this program that he thinks they need to make a move in July. This is what Mohamed has to say on Bloomberg Opinion today. Failing to ease policy in either July or September, an outcome that unfortunately can't be ruled out, would constitute another policy mistake for a Fed seeking to restore its credibility after fumbling the initial response, Lisa, to building price pressures back in 21.
The fundamental question right now underpinning some of the commentary as well as the action that we're seeing in markets is how much of this is fundamental? How much is this true weakening that goes beyond just a normalization in the economy versus positioning reset versus technical versus a market that has seen its longest streak of wins going back years and up for 28 weeks of 38, which is something that hasn't been exceeded since 1989. This is a tension point at a time we don't have a clear view of how quickly the labor market is weakening.
That Dudley commentary, though, being picked up. Andrew Hollenhorst this morning. Fed focus has returned to the labor market, reflected in the Dudley opinion piece, who we'll be speaking to, and the Fed should cut rates next week. Jobless claims in focus this morning, but it may take until August to confirm a concerning trend versus a seasonal fluctuation. That's really a debate.
I'm far more interested in claims in about 28 minutes than I am GDP. I think Andrew Hollenhorst of Citi speaks to that. To your point on the price action, we can do this cross-asset, we can do individual names. Cross-asset, we've described this a few times as just a massive unwind of consensus positions that you see in equities, you see in bonds, you see in foreign exchange. Everyone short the Japanese yen, all of a sudden things whip in the other direction. Dollar yen negative for 4 consecutive sessions. But within stocks, there are these company stories that start to add up. Just the consumer starting to push back. We saw it with Delta. We saw it with United. American has been a messy story of execution misses over the last 12 months or so. But American again this morning, American Airlines having a difficult time. That's the airlines. Look at the auto manufacturers. The consumer's in one place, their production's in another. Ford's a big struggle. Stellantis is a big struggle. It's industry after industry in the last couple of days.
Where basically they can't raise prices as quickly as their input prices are rising. We heard that also from Nestle. This is a global story of margin compression and, frankly, consumers pushing back. This is the reason why not only today's jobless claims, but tomorrow's consumer spending numbers that we get will be important to give a sense of just how persistent this will be, given the fact that some of these airlines, and I'm thinking of American in particular, is down already 26% so far this year. The fact that it's down another 6.3% as it ratchets back its profit forecast for this year shows maybe people aren't really pricing in a low enough bar for some of these consumer-facing companies.
It's a bad time to report bad news That's for sure. I think we said that earlier this morning. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth as the S&P 500 sees its worst day since December 2022. We'll speak to the former New York Fed President Bill Dudley on his call for an immediate rate cut, and Michelle Girard of NatWest reacting to GDP data and jobless claims, which drop in about 25 minutes' time. We begin with our top story, the AI frenzy losing some steam. A global tech sell-off pushing the S&P 500 lower as investors reassess the AI trade. Cameron Dawson of NewEdge Wealth saying there's still time for a turnaround. Writing this, is tech dead? No, but it needed this breather. Tech went parabolic and got aggressively overbought at the beginning of last year. Tech can correct, support, and will remain and still remain in an uptrade. Cameron joins us now for more. Cameron, good to see you.
Good to see you.
What is this that we're seeing? Every single guest we've started the hour with, we've asked the same question. I'd like your opinion to the same question. Is this a rotation, a broadening out? Is this an unwind of consensus trades? Is it a growth scare that's starting to emerge? How would you describe what we've seen?
I think that there is very much a technical aspect. We got incredibly overbought, mostly in tech and growth. And I think the important point is the last 3 months of that move really didn't have anything to do with earnings moving higher. It was all valuation. So it was sitting on really fragile ground. You saw positioning get really one-sided. Everybody moved to the same side of the boat, whether we're looking at things like CTAs in the 99th percentile, households being just 1 percentage point away from peak positioning. So you had this setup for very high expectations, stretch valuations, stretch positioning, and this is just a digestion of that. The question is, do we have an earnings deterioration because of what we're seeing in inflation data, because of what we're seeing in growth data? If we see that, this is more protracted and it's deeper. If not, this is just short, shallow like we've seen over the last year.
Next week, Amazon, Microsoft, Meta, Apple. How low is the bar or high for them going into next week, given all of this?
I think based on valuations and positioning, the bar is very high. And we can see that throughout this earnings season, which is that there is absolutely zero tolerance for anything that even smells of weakness because positioning is so stretched. Now, this is good to take the air out of some of these areas simply because it allows you to potentially, over the medium term, extend the rally. We went truly parabolic in growth versus value in June and the beginning of July. It was going to end. And so this is good and healthy to shake out weak hands.
That said, it's one thing to look at specific companies and understand whether they're facing a good profit outlook or not. It's another thing to extrapolate it a larger macroeconomic story, and you kind of can't avoid it when you hear the same thing from company after company about pricing pressure and consumers pushing back. How much of a normalization versus a true weakening is this?
I think it's so important because the deterioration in CPI or the falling in CPI, which is good for the Fed, actually makes 2025 earnings estimates less likely. The lower inflation is, the less margin expansion and the less top line expansion we're going to get. We are hearing across the board that companies are having issues with pricing power. They are not able to pass on input cost increases to their end customer. This is very different than 2020 and 21. We saw input cost increases, but you were able to push that onto your end customer in a blink of an eye. Customers are now pushing back, which just means that that $277 a share that is now forecasted for 2025 earnings, we think is far too high.
Given that, are people conflating the idea of earnings coming under pressure, margins coming under pressure, with an economy that's truly rolling over?
I think that that is the key distinction, which is that it's deceleration, not necessarily falling off a cliff. And we see that in the labor market as well. You're seeing these signs of fraying, but you're not seeing an outright surge in the unemployment rate higher. You're still hearing talk of labor hoarding from the likes of the NFIB, the Conference Board. People are still saying that they're having trouble finding workers, which would suggest that you're still in this normalization, not necessarily outright weakness. It's slower growth, but not necessarily growth that's falling off a cliff. The challenge is, how does that compare with consensus? Because consensus is still expecting really robust growth, acceleration in top line growth next year. I think that's where the two come to meet heads.
You also have an election call. What's your biggest probability you're watching that could be the biggest cause of concern for 2025?
I think it's about sweeps. It's if you see the probability of a sweep, whether it goes Republican or Democrat, and we know that we're seeing these probabilities of who gets elected start to swing around pretty materially. But I think the sweeps is what the market is going to be the most concerned about, because it would allow the most extreme portions of policy agendas to get pushed through. So those are the parts of the policy that could be the most inflationary or possibly be the most exacerbating of high deficits. So if you see stalemate, then I think that's the outcome that the market breathes the most sigh of relief.
And how do you prepare for that? Or you can't until November 6th?
It is hard to prepare, because what we tend to see going into elections is you pull forward a lot of performance. You have this expectation that certain areas will benefit. It doesn't necessarily translate into earnings, meaning that you can see run-ups in different baskets of stocks prior to the election, and then it becomes a sell the rumor, buy the news kind of situation.
Let's put a bow on it. You said the uptrend can remain intact. What gives you that confidence?
Well, we still have room to pull back to trend. We still see overall that the economy isn't falling off a cliff. We reserve the right to change our mind. The market is not oversold yet. And I think that's an important point here, is we think that this correction continues. You can measure it by looking at the RSI. We're not externally oversold. Internally, look at the percentage of names above the 50-day moving average. It's still at 58% for the S&P 500. That usually goes down below 20% in a true durable low. We think that there is more chop to come, but you are still in a medium-term uptrend that remains resilient. You were back in October of last year. You were back earlier this year when we had corrections. So seeing that medium-term, long-term view remains very important.
Futures negative by 0.2. Cameron, appreciate it. It's good to see you. Thank you. Cameron Dawson there of NewEdge Wealth. This note just dropped. It comes from Baird. Apple price target raised over at Baird. New price target 240. Was 200. Here's the quote. We believe Apple Intelligence could provide a much needed upgrade catalyst, boosting revenue and EPS growth meaningfully. Apple also had a difficult session yesterday, Lisa. There's some pushback from the South side. An upgrade.
Here's the real ultimate question, and that's why our conversation with Waldemar earlier this morning, Waldemar, was so interesting, of KKR, which is it's a matter of timing. How quickly some of this AI technology and sort of other types of technological advancements can become profitable. And a lot of people are doubling down and saying this is a bigger revolution than the internet was.
I'll let you know the big tell. It's when I upgrade. You know, getting the itch a little bit.
You're the bellwether.
Without a doubt. If it happens in September. This note is about people like me who've got iPhones that are years and years old and have just sat on them and
You're
haven't
the main
upgraded.
character.
Let's
Absolutely.
see if it happens. I'm always the main character.
I know. Well, you need to come in and say, I'm going to upgrade.
Aren't you the main character in your story? Isn't that what life's about, Bramo?
Absolutely.
Let's get you an update on stories elsewhere. With your Bloomberg Brief, the main character of this show, it's Danny Berger. Hey, Danny.
Hey, John, thank you for that. Southwest Airlines reporting a better than expected second quarter profit, seeing a boost for summer travel. Shares still down 4 1/3%, though. The airline is also introducing a change to one of its defining passenger experiences. Seats will now be assigned as the company ditches its free for all policy that's been in place for decades. The change comes after it was under pressure from activist investor Elliott Management, which says the airline has failed to modernize its business to appeal to customer demands. For the first time in 4 years, Royal Caribbean Cruises is reinstating its dividend. It's the first cruise operator to do so since COVID ground the industry to a halt. Now, record demand is putting it on firmer footing. Royal Caribbean will pay out a quarterly dividend of 40 cents per share. Meanwhile, robust growth means it's reached its financial targets 18 months ahead of time. And Gen Z is showing its support for Kamala Harris. Vote.org reported that nearly 40,000 people registered to vote in the 48 hours after President Biden dropped his re-election bid. 83% of new voter registrations were for people between 18 to 34 years old. It's the largest number of registrations in a 48-hour period this election cycle. And that's your Bloomberg Brief. Back to the real main character.
Hardly. Danny, thank you. Everyone's a main character. Isn't that a Joe Rogan line? I think that's a Joe Rogan line.
I have no idea. All I know is
what would the main character do?
All I know is that this is sort of disclosing too much, but at home I was having a discussion with my son and he said to me, oh yeah, you're the main character.
Is that where that comes from? I'm pretty sure that's a Joe Rogan thing. It talks about, like, if you were the superhero, what would that person do?
Everybody
like
should
you
be.
In the movie,
but everybody should be in their own life. You know, that's an important thing. If you're not, I mean, who's going to be for you?
The problem is around this table, I think everyone just has main character energy.
Is that what's going on around here? This is a good time to go to break. Cameron wants to run. Up next, the morning calls. Plus, conversation you don't want to miss. Former New York Fed President Bill Dudley on his big call for why the Fed should cut right now. That's next. Equities on the S&P pulling back by 0.25% on the S&P 500. The rally in the bond market continues. We're down almost 8 basis points now on a 10-year to 420.76. The rally at the front end continues as well on the 2-year. We're down about 6. The data drops in about 14 minutes. Let's get you some morning calls. First up, TD Cowen lowering its price target on Chipotle to 65, keeping a buy rating. The firm saying it appreciates management's attention to improving publicity regarding portion sizes through operational changes. The stock is up by a little more than 1%. Your second call from Barclays lowering its price target on Ford to 16, maintaining an overweight rating on the stock. The analyst noting the automaker's significant second quarter miss, which was disappointing versus elevated expectations. We're down there now 13%. And finally, Citi downgrading Lululemon to neutral with a $300 price target. The firm seeing slowing spending trends in the active apparel space, also noting likely promotional pressures in the second half. They're down about 3% in early trading. And looking ahead to next week, here's the big call of the last 24 hours. Former New York Fed President Bill Dudley saying this: officials must cut, and they must do it now. Dudley writing in Bloomberg Opinion the following: the facts have changed, so I've changed my mind. The Fed should cut, preferably at next week's policymaking meeting, although it might already be too late to fend off a recession by cutting interest rates. Dawdling now unnecessarily increases the risk. Bill joins us for more. Bill, wonderful to go on this kind of journey with interest rates with you, because I remember at the very start of the conversation coming out of the pandemic, you were one, together with the likes of Mohamed Al-Eri and Larry Summers, warning that there were going to be inflation pressures and this Federal Reserve needs to hike. You've changed your mind, Bill, and in the piece, there are several points you've made as to why you've changed your mind. I want to pick up on what I think was the third one, the labour market. Bill, what's happening there that's guiding this call?
I think you can see the labor market is slowing, especially evident in the household employment survey, which is much weaker than what we've seen in terms of payroll employment. Over the last year, household employment's increased by less than 200,000. I think the labor market, the second part of the labor market story is, of course, the rise in the unemployment rate. We were at 3.6% a year ago. Now we're at 4.1%. And these kind of rises in the unemployment rate are essentially warning signs. Every time the unemployment rate has gone up by more than 0.5% on a 3-month moving average basis, the U.S. has had a recession. This is a so-called SOM roll. Right now, on the SOM roll basis, smoothing it, 3-month moving average, 0.43% increase. So we're getting very, very close to triggering the SOM roll. You know, Chair Powell himself has pointed out the risks now are very much two-sided, not one-sided. Inflation is much more benign, 2.6% for the core PCE deflator year over year, and we're probably going to get another good reading on Friday. So I think it's time to start to focus on the risks of the economy, the risks of the labor market, to minimize the risk of recession, which always occurs when the unemployment rate goes up by more than 0.5% on a 3-month moving average basis.
Bill, let's talk about timing then. This was Chairman Powell in Sintra, Portugal, so not even a month ago. He said, we have the ability to take our time and get this right because the US economy is strong and the labour market is strong. Based on your piece, just on the timing, they might already be too late to fend off a recession. Why are they miscalculating how much time they have, in your opinion, even though they have acknowledged what's developing in the labour market?
Well, I think they put not very much weight on the SOM roll. SOM roll's perfect track record since World War II, 13-0. But their view is that the reason why the unemployment rate's going up is because labor force is growing rapidly. So that's not as disturbing as if the unemployment rate was going up because people are being laid off. The problem with that story is that in the 1970s, we had labor force growth that was also extremely rapid. SOM roll held. So I think you want to stick with the SOM roll until it's disproved.
That said, Claudia Sahm of the SOM roll has actually come on and said, people put too much emphasis on my SOM roll, and actually backed away from using that as one indicator to really end all be all. Is there anything other than that that creates new urgency for this sudden pivot, really a week before the Fed's meeting?
Well, if the Fed doesn't cut in July and waits till September, it's not going to have a huge effect on the economy's trajectory, except the fact that when the unemployment rate starts to deteriorate, it seems to be a reinforcing negative feedback loop. Jobs are lost. People pull back on spending. That leads to further cuts in the employment and investment. So the striking thing about the Sommerl is not just the 0.5% threshold, is the fact that every time you've gone through that threshold, the unemployment rate's gone up a lot. The smallest increase when you go beyond 0.5% is almost 2 percentage points. So that just tells you that once things start to unwind in a negative direction, it tends to keep going, and that's why the risk here is significant.
Bill, your column got a lot of attention, and in large part because you were on the forefront, as John was mentioning, of this idea that the Fed would have to raise rates much beyond what people currently thought at the time, and that maybe even the neutral rate was going to be higher than what it was in the past. Based on the weakening that you've seen, are you rethinking that concept that inflation is going to be structurally higher and that the Fed's going to have a harder time combating it in the future?
Well, if the economy slows and the unemployment rate rises, then the downward pressures on inflation are going to persist. 2.6% is really not that far away from the Fed's 2% inflation objective. And in my mind, that difference is not sufficient to take a big risk of a recession. So I think it's time for the Fed to focus on the other side of its dual mandate, which is the employment side. Powell has talked about the fact that the Fed has two objectives, inflation and employment. And I just feel like the risks on the employment side are increasing to the point that you want to put more weight on that.
Bill, are there things you can say as a former Fed official that you can't say as a current Fed official? I'm just interested in the communication of this. You can speak your mind now freely with us. You can write the piece on Bloomberg Opinion. Can you imagine what the fallout would be if we had the current New York Fed president or the chairman of the Federal Reserve saying the things that you're saying right now at the July Fed meeting? Do you think they can even do that, even if they thought it?
Well, I think if Chair Powell was of the view that shared the same view as me, I think he would probably talk to the other officials and develop a consensus to move in July. I mean, I think one of the interesting sort of quandaries of the Fed is, and right now they've telegraphed it pretty clearly that they're going to move in September, and it sort of begs the question: if it's so obvious that you need to move in September, then what are you waiting for? Why not just move in July?
At this point, there are a lot of people who are associating political reasons for why someone might want to come out and say that now is the right time to cut. Since the data hasn't weakened that dramatically in the past couple of weeks, we have seen an ongoing deterioration that seems consistent with a normalization. Bill, how do you counter those accusations that this is being done ahead of an election, highly contested, where if the economy can keep doing okay, typically the incumbent or the incumbent party does better?
Well, I think my experience, and I think this is borne out by the Federal Open Market Committee transcripts over many, many years, is the Fed doesn't take politics in consideration at all in terms of this timing of monetary policy, rate increases or rate cuts. And I think that's the appropriate behavior by the Fed. They need to be independent. They shouldn't be taking the election cycle into consideration. And I don't think the Fed is doing that here. I think the reason why the Fed is delaying it is I think they were surprised last year when they thought inflation was coming down, and it turned out we got a number of disappointing readings on inflation. I think they're also probably waiting because Powell probably wants to achieve a full consensus. I think he'd like to see a unanimous vote in favor of easing. And the hawks may be, there may be some people who are hawkish on the FOMC that are still a bit reluctant. I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting.
Hey, Bill, it's great to catch up with you, sir. Appreciate the insight. This piece yesterday on Bloomberg Opinion got a ton of attention. The former New York Fed president and Bloomberg Opinion columnist, Bill Dudley, there on his call to start cutting interest rates like yesterday, right now.
And he talked about the Sommerl. He talked about how it just the balance of the mandate just seems like the labor market should take on a greater degree. I just want to take it a step further, though, this idea that how much does the Fed not want to seem like they are perceived as being political? How much of a push that becomes for them not to cut rates, even if they feel like the economy might justify it?
They want this smooth glide path. They always do. They want this smooth communication. They don't want to rattle people with sudden turns and big decisions that seem to come out of nowhere. So they're setting us up for September. I think the risk here between now and September is a risk that Mohamed Al-Erian has highlighted. that they've been so data point dependent, and this is the point that Neil Dutta made recently on this program, that it wouldn't take much to spook them. You get one hot CPI print and maybe they back away from September, and that's the ultimate risk here.
You get one bout of commodity inflation that causes a CPI print to look hot. All of a sudden, it's really difficult.
So the distance between a rate cut and not a rate cut apparently is a couple of months. End of July and September. It's that big deal? We'll talk about that in a moment. The data drops next. "60 minutes away from the opening balance, seconds away from a ton of economic data." Mike McKee's in the studio. He'll break all that down for you. The scores look like this on the S&P 500, pulling back a little bit. We're down 0.25% on the S&P. We take some more weight off the Nasdaq. We're down 0.4% after yesterday's big sell-off. The bond market is rallying into this data. The 2-year, the 10-year, the 30-year yields are lower across the board from anywhere between 6 and 8 basis points. The 10-year's down 8 at 420.37. With that economic data, let's get across to Mike McKee. Morning, Mike.
Good morning, John. Well, we have an upside surprise to GDP. 2.8%. The forecast was for 2%. Consumer spending comes in at 2.3%, certainly stronger than the 1.5% last time. I know, John, you've been dying to hear what's happened with jobless claims. 235,000, so we get a drop of 10,000 from a revised 245. There was talk last week of the jump that we saw being because of Hurricane Beryl in Houston, and that may have been the case. We'll look at where the big changes are. Durable goods orders down 6.6%. However, capital goods orders, non-defense ex-air, up 1%. Remember, it was down by a 0.6 margin last month, and the expectation was for just a 0.2 gain. So business spending looks strong, consumer spending stronger than expected, GDP stronger than expected, and Bill Dudley says they got to cut rates. So, I mean, if you're at the Fed, you're just throwing up your hands going, I don't know.
Look, this debate's not going to change based on this economic data this morning. The pricing of everything might, though. Equity futures at the moment look a little something like this. We fade some of those losses. We're down 0.2 on the Nasdaq, down 0.1 on the S&P. We fade just a little bit of the rally in the bond market, just a touch. Yields were lower than this. They're still lower, still down on the day, but not as low as they were. We're down 4 basis points on a 2-year. On a 10-year, we're down about 6 basis points. Jobless claims, jobless claims, jobless claims. All the labour market data between now and the Federal Reserve's next decision is the difference, Lisa, between having time and running out of it. And if you look at that in isolation this morning, the picture around claims a little bit better. The people who are in the camp that they have time have a little bit more data behind them.
And the people who say that they don't have time will say that things can happen very quickly and that you've seen a gradual kind of weakening. This is data that makes it a lot more complicated and difficult for the Fed. And I would say that that's what you see, especially given the fact that when you look at the internals of this GDP print, you're seeing an upside surprise to the core PCE price index over the 3 months. So we're looking at a really pretty strong read there at a time where jobless claims aren't falling out of bed, even though there are other signs broadly in the soft data pointing to a dramatic weakening in certain sectors. This data doesn't show it.
Mike, you'll have some time to go through all of this line by line, but just an early read on things. That GDP surprise, that positive surprise, what's underpinning that?
Well, it looks at this point like what we're seeing is strength in consumer and business spending as opposed to an inventory kind of thing, although inventories appear to be bigger. I'll get those numbers in just a second. One thing I did want to point out, the price index for the quarter, which the Fed doesn't pay as much attention to because it's a quarterly average, comes in at 2.3%. That is significantly lower than what had been anticipated before. The second quarter PCE 2.9%, I'm sorry, annual rate 2.7%. That will give people the idea that we're going to get a decent number tomorrow.
At this certain point, it's not about whether or not the economy is falling off a cliff. It's about the balance of risks for the Federal Reserve in terms of the labor mandate and the inflation mandate. Is there enough confidence, given the fact that there is an upside surprise in this GDP print to the inflation metric, that you're seeing jobless claims actually go down from last week? So potentially the distortions you were talking about. Is there anything in this data to suggest that the inflation beast has been slayed and that that's sort of an ancillary question and that really the focus is still squarely on jobless claims?
Well, I would go back. John knows Hammer Films in in London with all the Dracula movies, and they'd kill it, and it would, you just pull the cross out and they'd come back again for another movie. That's what the Fed is afraid of at this point. You can't say it's been slain, but you can say that things are definitely getting into the territory where the Fed has said it would cut rates. Now, when you look at the GDP numbers, you have to figure that it would probably take a July surprise off the table because the GDP is strong and the PCE numbers are going down. I mean, on a quarterly basis, 2.3% for the headline and 2.0 is their target. So they're getting pretty close here. So at this point, you have to figure that if they do anything, they'll be setting us up for September. And you were talking about the yield curve earlier. I mean, the markets have priced in a July cut, essentially. So they don't need to cut to get the effect that they're looking for.
Just how dark are these conversations you have with Fed officials down in DC? What are you talking about? I know, seriously. Scary stuff. Mike McKee is going to stick with us. Michelle Girard of NatWest joins us now for more. Michelle, only 15 minutes ago, we just had a conversation with Bill Dudley, who was making the case to cut interest rates in July. You're making the case that they're going to cut in December. You've got some additional information. Why does this picture this morning validate your stance?
Well, let me just begin by saying we have backed off pushed off our call for a Fed rate cut pretty consistently over the last year. We had been expecting the economy to be weaker and the Fed to be cutting rates sooner. We've had this December forecast in for a while, though the data and the rhetoric have mounted to suggest it could come sooner. We've just got a lot of information, as this morning's numbers suggest, the employment numbers next week, which I think needs to really fall into line before we would confidently say, all right, we should move from December to December, having been burned many times before. I think what Mike said was exactly right. The numbers this morning take away the risk of a July surprise. That it removes the urgency for the Fed to have to act. Next week's employment data will be very important. The claims numbers this morning, again, kind of complicating the picture for the Fed. Next week, we've got a forecast for 170,000 gain in employment and unchanged unemployment rate. Complicates the picture again a bit for the Fed in terms of just how urgent does the Fed feel they need to act. I think the data that we'll see between now and September, we don't rule out September at all, but we just don't want to get whipsawed as we've been so many times like the markets this year.
Michelle, if unemployment crept higher, and this is really a little bit of scenario analysis, I just want your opinion on how they might respond to this. If we triggered the SARM rule going into this meeting, I just wonder how they might respond to all of this. How would you expect them to respond going into September if we triggered the SARM rule? How would things change?
Well, again, even as Bill Dudley points out, the reasons for the uptick in the unemployment rate are not quite as worrisome. It doesn't suggest that the labor market has imploded, obviously with labor supply increasing. So I don't think the Fed would want to appear panicked. They've set I think the train in motion in terms of setting the stage for a September rate cut. Even if we were to get a sharp upside surprise, or I should say a negative surprise in terms of the economy and upside surprise in the unemployment rate, I don't think the knee-jerk reaction would be to want to cut rates in July. Again, the Fed doesn't want to appear panicked, particularly when the underlying breadth of data do not suggest the broader economy is falling out of bed. So I would still expect that they would keep on the same path. It would just clearly the odds of a move in September would ratchet up dramatically, and the rhetoric at the Fed meeting, as well as the Jackson Hole, obviously, conversations in August would certainly, I think, definitively set the stage for action in September.
Michelle, just taking a step back, do you think that overall the balance of data suggests that the balance of risks for the Fed are much more squarely focused on the labor market right now, and inflation is much less of a consideration?
I don't know if I would go so far as to saying we've shifted from with the two concerns or mandates now more toward the employment or economic situation than inflation. I mean, you clearly have seen the Fed move from focusing primarily on inflation to a more balanced approach and looking at both of the risks. And I think that that's, appropriate. I think also stepping back, as you say, and looking ahead, we've mentioned the politics. I mean, clearly the timing of the election may, on a near-term basis, factor into the market's discussion, at least, about the timing of a rate cut. But when you think about the implications, perhaps, of a Trump presidency and the potential for tariffs, which could increase inflation, there are offsetting risks on the inflation side as well. Yes, we've got a downtrend in place. The Fed's growing confident that downtrend can continue. But when it looks more broadly, there are risks to the inflation outlook under certain political scenarios, and that too has to factor in. So again, I think where the Fed is, where they're looking at both risks as relatively balanced, and I think that's probably appropriate.
How much do you think, though, the markets would sell off if the Fed didn't cut rates at this point in September?
Again, I think it would be a disappointment, and I think you'd see the markets react. But it does get back into the messaging around it. If for some reason there's just an expectation that the move has been delayed to December as opposed to September, and the Fed is still on the path, clearly the market's going to be disappointed because it's pricing in almost 70 basis points of rate cuts this year. So if they don't move in July and September, and you're only going to get one cut in December, the market has to reprice for far less easing this year. But as long as I think the markets are anticipating that the next direction in terms of the Fed taking action is to cut, that there is some underlying support there that would be sustained.
Michelle, sticking with December, just about for now. Michelle Girard of NatWest, appreciate it. Thank you very much. Let's turn to the bond market. I just want to sit on the 2-year just for a moment. The 2-year at the low of the session, the yield was down about 9 basis points, now down about 3. Economic data better than expected, just pushing back some of these calls for that imminent rate cut to take place, maybe even as soon as this meeting in July. Mike McKee still with us to break this down. Mike, GDP, durable goods, there's a lot in here, claims as well. What stands out for you?
Well, let me just quickly dispose of the durable goods issue in terms of headline number coming down 6.6%. Non-defense aircraft, Boeing, 127% decline. I wouldn't want to be in that business, talk about volatility. But then you look at the GDP numbers, and it's personal consumption 2.3%, non-residential fixed investment up 5.2%. Most of that was equipment, 11.6%. Structures were a big deal last year. This quarter, they were down 3.3%. We've built the factories now. They're putting the equipment in. So this should start to have an effect on the overall economy going forward. And then finally, with GDP, big drop in net exports that subtracts about 0.7 overall from GDP, but inventories added 0.8. So they kind of offset each other at this point.
Gennadiy Goldberg with us around the table as well from TD Securities here in New York. Gennadiy, let's get into this data first, and good morning to you. What stands out for you? Does this push back those calls for an imminent rate cut?
Yeah, I think so. I think July is off the table. I think it's been off the table for at least the last few weeks. I mean, if you look at market pricing, we've basically had, 1 or 2 basis points priced in for the last couple of weeks. I think it's really a function of September, November, December. That's the way I think about it. I like to think about it in ranges. So if you're thinking about, is it 1 or 2, 2 or 3 at this point? I think the data leading up to kind of this period in time has been calling for 1 or 2. Now it's a question of 2 or 3. So I think November potentially is in play, but we still think September is the first.
This is a very small difference in degree, but sort of walk us through it. What's changed that range for you from going 1 to 2 to 2 to 3?
Well, to the earlier point about, is the Fed really only focused on inflation, or are they actually starting to focus on the labor markets? There's been a very subtle messaging shift over the last couple of months about them actually starting to think about labor market weakening. It's no longer just about, inflation has to come down. Inflation has slowed quite dramatically. Now it's a function of, if the labor market is slowing down as well, maybe we do have some weakness on both sides of the economy, and we actually have to be a little bit more careful about not over-tightening rather quickly. So I do think for them, it's a function of, look, we want to take rates lower. We want to start cutting rates gradually. But if the labor market starts to show signs of weakness, We have to go faster.
That said, it seems like there's this feeling that we're not getting a clear picture from some of the labor market data. We've seen this again and again. It gets revised significantly. It can look very different a month later when we take a look back. How much is your sense that the Fed and the markets are saying we're going to look past blips in the data that show solidness and look more at the weakness and count more on that and protect against that? How much do you think the Fed is on board with that? How low is the bar for them to point to the labor market as a reason to start making those adjustments?
I think it's much lower. I think we've certainly gone lower over the last couple of months. What really surprised me in the last labor market print wasn't the actual print itself. It was the revision to the last couple of months. The fact that the 3-month moving average went from 250K to 177 in a single month. That's not the kind of volatility you typically get from a 3-month or a 6-month moving average, for example. So we've been flying well above the break-even pace, which is around 175 to 200K, we think. Now we've gone well to the bottom of it. And now the question for the Fed is, well, if that persists, are we actually net, tightening more than we should be?
Well, everyone who's come on this show draws a distinction between weakening and actually a recession. And nobody has come on and said we're heading into a full-fledged recession, except for maybe Bill Dudley, who said that, maybe they're too late. But other than that, everybody else seems on board with the idea that there still is quite a bit of strength in the economy. So at what point are you looking at what's been priced into the bond market longer term in terms of rate cuts has already gotten it over its skis? That, yeah, they might start the adjustment. It might be 3 rate cuts now, but the whole idea is to prolong the business cycle so that they don't have to make bigger cuts later.
Yeah, I think, and that's why I think a third cut is on the table this year. I mean, we officially have September and December cuts. The more labor market softening that we get, the more likely we are to get that November cut in play. And I know, everybody talks about the election as a potential kind of, stumbling block for the Fed. If they're cutting in September, they can certainly go in November, December, especially if they see labor market weakness. The big question for them and the bond market is 2025. Right. We've got the election coming up. We've got a lot of potential scenarios that could take us very astray from the soft landing scenario. We could have a big spike in inflation. What does the Fed do then? The bond market's having a lot of trouble pricing that one in. They're pricing in just over 4 cuts. And, the scenarios have gotten wider and wider and wider in the meantime.
How worrisome is it that the Fed may be cutting into an inflationary environment that Michelle was talking about? If we get high tariffs, that would, for the most people would agree, inflationary.
So I look at it as baseline versus the risk scenario, right? The baseline scenario, assuming there was no election, what would the Fed be doing otherwise? They would probably be cutting gradually, maybe a little bit faster if the labor market was slowing down into 2025. The question is, if we do get this inflationary spike, does that keep them on hold? Does that allow them to hike rates, as some have said in the market? We think it actually would allow the Fed to keep rates on hold, so higher for longer, but not quite at the highs. So if we get those couple of cuts this year, maybe to 4.75 or 5%, and we stay there for the first part of next year, and then the Fed reassesses, because we've got the inflationary spike coming through, then the growth shock actually impacting, and the Fed needs time to assess all that.
When we've been talking about the election a lot on this show, we talk about tariffs, the tax fight, but you're talking about even a bigger fight that potentially is going to happen at the start of the year, and that's the debt ceiling standoff. What's your base case for what the composition of the election could mean for that debate in Washington?
Right. I think the biggest risk scenario is mixed government. Split government, if you've got a Republican president.
But isn't split government good for the market?
Technically, yes. This is the one instance where I think this can actually create a big risk of a standoff. Remember, back in the 2011 standoff under Obama, that was split government as well. Nobody was really a fiscal hawk right up until the point where we got split government, and then all the fiscal hawks came out of the woodwork and then started to negotiate all of this. It is tricky from a timing standpoint, right? The debt ceiling gets reinstated January 1st. The X date, or the point where the Treasury runs out of cash, is only around, we think, July to September of next year. And it's troublesome because, Congress tends to be off in August. So either they deal with this before vacation or after, and it's going to get close regardless.
So we've gone through a bunch of issues. What are the trades you're recommending?
I still think from a net standpoint, you want to be net long 10-year treasuries.
Okay.
We're still long 10-year treasuries. That trade's done quite well. We're still in 530s curve steepeners as well. That trade's done quite well. I think you want to hold on to these trades from a longer term standpoint. Where I think there's risk is in that curve trade, right? We're not necessarily going to a straight line, back to neutral for 10-year for Fed funds. If we stay at this higher for longer range, right? If we end up at 5% for the first half of next year, as the Fed reassesses the risk from tariffs, from immigration, all of that can actually lead rates a lot higher. That long may not work out that well, and you want to start to reassess that. So there's not, unlike this year where everyone was in steepeners, next year is going to have a lot more trades if you want to stay on the right side of the equation.
How many times has the word tactical come up over the last couple of weeks, right?
How could anyone be anything
Which is like code for I've got
Yeah.
no idea what happens in the long term. Don't ask me.
And thank you. Thank you for the honesty. Because realistically, who could come on here other than Steve Eisman and say he knows with definitive certainty what's going to happen in November?
It's been like the theme of the programme, flying blind into 25. Big time. Gennadiy, it's good to see you. Thank you, sir. Gennadiy Goldberg there of TD. Neil Dutta of Renmac Publishers writes in, the data today will reinforce the notion that the Fed has the benefit of time. In the Fed's mind, there is no need to rush, with private domestic demand growing at a solid pace over the second quarter. July remains a set-up meeting for September. The title, See You in September. Which is what we heard on the politics from Libby Cantrill as well over at Pimco. So there you go.
This is basically the collective scream for please let us have a vacation.
Go on vacation. Go to the beach.
I will in a couple of weeks again.
Make it happen. Next week, right?
No, not next week. The week after.
The end of next week.
Yeah.
Good for you, Lisa.
Then you.
All right, then me too. And then AMH. Everyone's got a holiday.
Maybe.
Don't worry. All right. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. I just want to recap some of that data we got. Initial jobless claims, those came in at 235,000 last week. That is just a touch below estimates. As for second quarter GDP, that rose at a 2.8% annualized pace, well above the estimate of 2%. The GDP numbers, as Neil was saying, does ease some of those concerns that the Fed would need to rush to cut rates to avoid a recession. Let's check in on shares of American Airlines, lower by 3.5% pre-market. It slashed its earnings outlook for the full year, becoming just the latest airline to temper expectations as fare discounts and high cost pressure earnings. It is the second time the airline has lowered expectations this year. Americans saying they, quote, did not perform to initial expectations due to their prior sales and distribution strategy and an imbalance of domestic supply and demand. And Kamala Harris is about to receive some big-name political support. NBC News is reporting that Barack Obama plans to endorse Harris soon. NBC says that Obama and Harris have been in close touch since she announced her presidential candidacy on Sunday. And that's your brief, John.
Hey, Danny, thanks for that. Appreciate it. And thanks for this morning. Up next on the programme, we'll set you up for the day ahead. From New York City, you're watching Bloomberg Surveillance. Counting it down to the opening bell, about 37 minutes away. Equity futures here just about unchanged. Things improving following that economic data, but the bond market's still bid and yields are still lower. We're down about 5 basis points on a 10-year, down 3 on 2s, just a break of 440 or so. And in foreign exchange, lots of attention. Lots of eyes on dollar yen. Dollar yen still lower on the session by 1/3 of 1%, but nowhere near where it was. Lower the session today was 151.94, and right now we trade at 153.38. So that data earlier, better GDP, stronger dollar, yields up just a little bit off session lows, jobless claims a bit lower than expected, just parking some of those calls, some of that urgency behind those calls for a rate cut as soon as this month. Let's get to the trading diary, what the rest of the week looks like. President Biden and Israeli Prime Minister Benjamin Netanyahu holding a bilateral meeting at 1 p.m. Vice President Kamala Harris also with a meeting of her own with Netanyahu at 4:30. We'll round out the week Friday with PCE and UMich and another Netanyahu meeting, this time with the former President Donald Trump at Mar-a-Lago. Then we start to think about next week. I think we're already thinking about that with a ton of earnings coming up too. Looking forward to all of that. Final thoughts, guys. I mean, where do we begin?
The difficulty understanding the technicals from the fundamentals. People are saying that just was such a huge bid up in certain stocks. That's what we're seeing, the unwind of those popular trades. Currently, on the flip side, the earnings have not been great, especially from consumer-facing companies. So right now, what my takeaway is that no one wants to go past the end of this year. Nobody wants to even wager what that might look like. So they're trying to understand short term what it means if the Fed cuts rates, if data responds this way, to sort of game theory out one another, because trying to do the big picture, good luck.
And what policies happen next year for the Fed to cut or hike into? very confusing, staring into the sun. Lori Calvasino, that's what it
line.
feels like. I feel like last night with the president finally addressing the nation, we've put to bed he was just going to serve out his term, and it is a brand new race. And now I think next week it's all about where Kamala Harris goes, who her VP pick is, but actually the data becomes more important. This week felt like the politics was really important, and next week I feel like the data is more important.
Looking ahead to payrolls and a Federal Reserve decision as well, and all those tech earnings. Next week is absolutely stacked. Tomorrow's program is as well. Here's the lineup for you. First of all, David Malpass, the former World Bank president. We'll catch up with him about what's been developing in the bond market and issuance from the Treasury. And this recent paper from Nouri Arabini about whether there's been sort of this stealth QE coming out of the Treasury. We'll get his thoughts on all of that. We'll speak to Victoria Fernandez of Crossmark, Republican Senator Bill Hagerty. Look out for that. And I have no idea who booked this, but the AC Milan CEO, Giorgio Falani, joining the show as well going into the weekend. Who booked that?
Yeah,
why are we doing that?
AC Milan's playing on Saturday.
I'm passionate about AC Milan.
Good. You better be tomorrow.
I know. You're going to be like, how much do you know? Let's go.